Good morning. Adjust your audio. It is August 14th. Happy Money Monday to you. We're going to be streaming stocks, options, futures trading, watching some technical analysis, watching the SPY, GNS, BBBYQ, GME. We'll see what's going on today. Be a pretty exciting week. Sub up, like up, comment down. Happy Money sticks around. You can follow us on Twitter at HappyMoneyYT, as well as our Discord server. Link for both of those in the description. I will add a Discord link to chat as well. How'd you guys do? How'd you guys do the weekend? Did you do it right? Good reset. Are you stressed about barbecue all weekend? Sitting inside, shivering and cold sweating. Morning, Mo Lava. Trying to reclaim your spot as first chatter in the morning. I can see. Morning, Bubblicious. Morning, Brent. Universal Studios. Nice. Like the hottest time ever to go there right now. Florida's getting like record heat. Hope none of you died. Yeah, AMC did take a dump on the ruling. And Ape ripped. So the arbitrage play ended up working out. Those that played it, well done. Our GNS is up pre-market. I guess I ended the stream. I bought back into GNS after hours on Friday. It made the 38.2%, that first fib level retracement. Bounced on that, and then I was just thinking, you know, this thing come into a Friday, bounce on a fib level. It's showing a lot of strength. Like, it didn't look like profit taking hardly at all. So I want to get back in. I went in with just the amount that I had in profits, so basically took all the risk off. And yeah, there we are. We're back up to the highs of yesterday. So far hasn't even hurt me, because this is basically where I sold yesterday. So could buy back in where I was. I guess I did buy back in here. So far it's worked out better. We'll see. I'll probably be buying in more if we break the highs here. Probably back to the position I had, or maybe larger. Yeah, we'll just have to see if it's starting to consolidate. I mean, it is finding resistance at that high now, but the momentum of this thing has been awesome. Of course, on Friday that was a very large green day with lots of volume. So yeah, we'll see. SPY, not sure what I was looking. Nothing was of significance came out this morning that I know of. We were up pretty good pre-market, and we've sold off now, down 0.20%. GNS is up pretty good. If you guys were following Liquor, it actually had a rip Friday into close. 100% rip. That was interesting. Looks like it halted in here too. We weren't really watching it anymore, but it looks like it ended the day green. So insiders maybe have finished selling, and time for some buyers. I don't know. It is quite a big movement today there. Thought about even averaging into it. We'll see, because it would just basically be on the hype completely. I think it's a cool business and cool business model, and they don't have any debt. Like, there's a lot of cool things about it, I guess. Overpriced now, I have no idea. Maybe, because it sounded like he said the banks bid it up. So the actual IPO price was probably not $5, it was probably like $2. And then the banks bought it up, and then when they released the IPO, it did it at $5. Just to dump it on everyone. Just standard operating procedure for IPOs. Unless if they directly list IPO, which we did see some of those last few years. Kind of interesting how they trade. Was there for GNS and it was 70 cents. I don't know if that was the right play. Was it? Another apes up here? Probably, just because I think that's a stupid figure. 70 cents on GNS is quite nice, so go what? Go what? Let me get rid of these fib levels. We got the 2 channels at that trajectory, and now the steeper one we start on Friday. Let's see. Doing 30, nice. Well, there you go. Smart play. All right. Let's see. 20 minutes open. GNS is above yesterday's high now. So that is neat. Yeah, I guess scaling out and being able to get back in, good way to do it. Be flexible, like water, liquid. With GNS, I mean, who knows where it's gonna stop. But taking profits along the way is smart, and then adding back in where it, breaks resistances after consolidation, basically. That's the best way to do it, instead of just taking all of it out and then hoping to time the top perfectly. Yeah, it depends on how active you want to trade it, though, I guess. We have some dates coming up. We're gonna hear from the CEO on the 17th, which is Thursday, so it might be a sell-off that day. And then this is the record date, 31st. So maybe a sell off that date. Seems like that's a good way to do it, human chop. At least it's worked so far. It'll probably keep working until it doesn't. When it doesn't, it'll be sad. Oh yes, RAD. I like RAD's bounce too. Want more? RAD might go crazy. Oh, that was me. Not buying more barbecue. Yeah, I just bought back in, I guess it was yesterday, it was Friday, yeah. Picked up some right here. I don't know if I'm gonna buy more or not. Chart's looking nice though. We can hold above here. Alright, about 6 minutes to open. SPY retesting the lows. Yeah, hopefully barbecue can hold up this resistance. Make a little inverse head and shoulders up here. And maybe it'll be a quick cup up, like we had here, or even here was pretty fast. You know, the downward slope was much slower than the upward. We'll see if we can reclaim the high, that 40-cent area high. I don't know if that'll be able to happen before 818, but yeah, I don't know if I'm going to hold through whatever catalyst is on the 18th. Yeah, I did 107% the last hour. Close to the last hour. Crazy. Joan? Joan's up almost 10%. You doing, Joan? We've got we up 12.5. Things made quite a bounce. MRS is up 15% pre-market. GME's down 1.6 pre-market. Tesla's down 3. It looks like it's going to be opening up below that gap fill. Maybe it fills it to the upside. Pretty ugly open for Tesla. 3.25. RAD's down 2. It's just flat. GNS hanging out at the highs. ROFE on GNS is still up near 100%. Hasn't really made a big move up yet. Kind of sustained around 100%. For a while. 6 months or so. Ding, ding, ding. There's the bell. SPY's opening up down 0.25%. We've got GNS up 20. Happy Money Monday to you. Says GME's down 2.5. Barbecue down 2.25. The market's still sleeping. Very sluggish brokerage, maybe. Whoa. NAG is down 1.6. NAG. Nirvana's down 3.8. Got RAD down 5.5. Elladoc down 1.3. GNS coming down a bit below VWAP. Whoa. Again on SPY. Steel is up 27%. After company rejects Cleveland-Cliffs offer but says it's reviewing others. Takeover interest, huh? Wow. Those have been some nice options. We's up 17%. GNS also at 17. RAD down 5.8. Barbecue down 5. So far not holding above that secondary breakout. We'll see though. Still think it could. Musk wants to take our eggs. That's funny. I bet he does. Just gonna buy US deal just to get the ticker. Is it down? Down 2.5. Liquor House down 15. Given it did rip into close yesterday, so maybe it's making a higher low. That's hopeful. Oh, GNS. %20 now. 23, starting to pop a bit. I almost need to decide if I want to day trade it, because this morning you could just get a pump and then it drops back into, yeah, there it goes GNS. Pops back into a trade. I don't know. The problem with the morning action. Okay, I picked up some more GNS. See if I got duped. I liked how it held into Friday. Could very well see those 110 numbers again though. So maybe get some more down there. We'll see. It's coming down now. Is also coming down. Barbecue's down 4. GME's down 3 1/4. That's pretty big. No, it's just illiquid. I still just kind of chopped around from where it opened. RAD's down 7%. Let's see if GNS is just triggering some stops. Carvana's down 4 1/4. Tesla's bouncing a bit, 2.6. RAD at 6% down. Liquor's down 11. Holdoc's down 1.5. Do they need a bounce? On what? Everything? Teladoc back below that breakout level. This is a very ugly earnings continuation. GME down 3.4 now. Alright, well GNS is holding up there at least. Morning tasty. Barbecue down 5. There's a gap fill there now. Or no, that's not. That's just intraday. I wouldn't count that as a gap. Sink or swim. Lagging. Dang it. Alright, I missed the calls there. Okay, I'll wait. Broker's going slow this morning. Go GNS, alright. We up 11. RAD down 6. Excuse me. .5 on GME. Barbecue flush down 8%. Could be repeating this again. That was my concern. I was going a little early, but still hope. Eyes coming up a bit. I mean, it was up pre-market, I think, 0.25%, so. RAD's down 7 now. .3. Might be looking for some more on a. If we bounce on that level, that $2 level. RAD down 8, barbecue down 7, he's up 9.5. GME down 3.8. Barbecue down 8. Oh, GME's kind of flushing here. Down 4.3. Finally, it's moving some. Guess this day was kind of big too. You at 18 bucks. Gamers. %, on barbecue. Not a strong open. Watch if it bounces. Friday's low. Little flush on SPY through VWAP. GME was just front running SPY there. He knows what's up. Whoa, new low of the day there on SPY. Flashy flash. GME's down almost 5. Left a gap up there too. Barbecue's down almost 10. GNS is coming down a little bit, still up 15, 16%. Down 4. And the SPY's bouncing right back up there. There you go. There's your chop. GNS coming back down a little bit. New high of the day there on SPY. %10 on barbecue. Liquor's down 10%. Got a little cup here. Might be the handle forming, but it's choppy. Not straightforward at all. Just trying to shake out all the squeeze stocks. Hey, Julian. I don't know. I don't think there's any news. I've not been keeping up too much with the barbecue. I mean, it's just right back to where it was on Friday, more or less, before we had the run up. So, potentially showing signs of bottoming out here, which would be good. If it holds some levels, just be a slower cup that it's building instead of an aggressive one. Buy back down to VWAP. VWAP. GNS holding there, 17%. GME down 4.7. Pretty big sell off on GME today. How's Tesla doing? 2.5. $22 is a low. They hit 22.50. Excuse me. GNS popping up. All right, okay. I just dancing its way around VWAP. RAD's down 7. Bit of a bounce there off at 21 up to VWAP. GME down almost 5. Hasn't really had a bounce yet at all. Shocking. Doc is just ugly. Ugly. Dish down 2.5. It's not shading these channels anymore. I don't know why. Oh. Shaded darker. I think I like the lighter shading. RAD down 9. GNS still close to 20%. Barbecue still down 10. Hit in the morning. Weekend funk shaking off this morning for Happy Money Monday. Thank you guys for your support today. We're at 11 likes on the day. I appreciate it. Bit too much there. The high is jumping around this morning. Thanks, Kevin. Appreciate it, man. Thing is just spazzing out. GME's not. It's just been selling off. Same with barbecue. They don't occur. I don't know about Happy Money Monday. RAD also down 8. GNS holding up really nice. Got wheels up 8.9. I picked up some more shares of KBNT. Put it on Discord. Excuse me. Yeah, I grabbed some calls. Boing. Got him just before that candle. That is neat. GNS 23%. I like want more, but I want to buy more right now. That'd be crazy. I just wicked back down. VWAP. Not so neat anymore, are you, Bobby? GME flushed down there, 5.5%. Yeah, pretty big sell-off on GameStop today. It's making its way to that 18 in a hurry. $19 even. Or $19.10. Is really building up some liquidity here. All this chop here. You do have kind of an inverse head and shoulders. If it breaks the shoulder or the neckline, or if we just continue to chop and back down. Undecided at this point. Little bounce to VWAP on barbecue. VWAP's very low. Still down 8%. There you go, SPY. Moving up there. See if we can actually sustain direction. Good morning, Guts. Appreciate that. Hope you have a good trading day as well. Quick barbecue kind of had a bounce back up and bounce back to VWAP. Whoa. Barbecue all over. What's the big sellers on our watch list today? Well, yeah, AMC. Of course. Actually, RAD's down here. Is 8%. See a bounce there, Radical. A nice bounce today. Carry on with Friday's momentum. Doing a little bull flag action up here. Fish is down 3.4. New high of the day there on Le Spy. Rip Rodrigo. The price action on SPY's money is wild. It's like it's in fast forward almost. It can't keep up with itself. Whoa, up and down. Oh. GME, no relief bounces or anything yet. 5% down. Barbecue is bouncing a bit. That is nice. Back above VWAP. It's down 6.6 now. There's a new high on the SPY. Amy is not playing along. Barbecue is though. Barbecue's bouncing. Down 5% now. I like the consolidation of GNS. That's pretty solid. Alright, I'm gonna sell a couple of calls there. Sold a couple more there. Barbecue. Look at barbecue. Look at that. That's crazy. Crazy wild. Down 5%. Looks like it almost made it back up to highs of Friday though. Going for that gap fill. RAD made new low there, down 9.5. Excuse me. Ah, new high there. New high of the day. Rip. Up. Apple. Crack. Reaching for the stars. There you go, SPY. Looks like we're making it back up to pre-market levels. 4 hops. Getting closer at least. There, woke GME up a little bit. Little bounce up to VWAP on it. Big barbecue still spazzing out. Over 650 reversed. Maybe, yeah, we might get a reversal today. Still holding a couple calls. GNS still consolidating at those highs. Barbecue down 5.7. Above VWAP though. Looks pretty good on that hourly. It's just a wick down there. So I want to see. RAD 9% down, 10.3. Let's sell one more call up here. And I'm gonna sell my last one. Okay. Well. Give it some time. Might be getting into puts up here, we'll see. Because up here might still be down here. Might not actually be up here. There's a bounce on gamers stock. Little bounce on RAD. Excuse me. They get into some puts up there. I'm gonna have set a stop loss on these. It's gonna be pretty tight. In case we're just getting a little more of a pullback for the bulls to keep going. That's not an actual top and reversal. GME above VWAP there. Barbecue down 4%. RAD down 8.6. Here's 3% down on barbecue. GNS went down a little bit. 16 still. Now we're down to 444. We'll see. A pretty tight stop on these puts. Maybe too tight, which is fine. It's fine. Oh, I need to do my thing. The thing is, I don't know if I can do it on options. Let's see. I guess I probably could. Should practice. 4 4s. By the time I'd set all this up, it would just be silly. Wait. Okay, I got stopped out. But for credit, there it is. Okay, yeah, so I could do it on here like this, short position. I bought them at, I'm out of them now, but just practice. We got, let's see, there were 444s. I got them, bought them at, I'm at 32. Bought them here. It's a little confusing because it's showing me this account. Not you know. I was doing 3-to-1 risk to reward. I have a much wider stop. Oh wait, it's the other way. I'm thinking put, so it's going down, but it's actually the other way. Oh, it's not. Yeah, okay. It's not a short position on the puts. Okay. That makes sense. The 32 cents is what I bought it for. It doesn't have to be that wide, I guess. Oh, my stop was what, 28? Yeah, pretty tight. So then my take profit would be much lower. Wow. That's interesting to visualize. Because more realistically, I'd be waiting for TA, and contracts would probably, before I take any profit, they would probably be like up here. So that means I could widen out my stop loss quite a bit. However, looking at TA, if these contracts came down this much, then it would have canceled out, I guess, the TA for me. So why this system doesn't necessarily work, unless if you're just going off of whatever. I've thought about doing paper trading it, or even doing a real account, just like a small account, and literally just flipping a coin, or having a poll and asking you guys long or short, and then doing it and just following a strict 3-to-1 risk reward and seeing how it would grow. Just proving that it doesn't even matter what direction you go with. You just have good risk management. You're gonna grow an account. VWAP is the volume weighted average price. Now SPY got the trigger through those stops. Now I might kind of want to get back into puts. Barbecue down 3%. Got GME down 4%. GNS is actually consolidating. Nice. RAD down 8%. Happy Monday to you, Christopher. Good morning. I don't necessarily have targets. Ever. Just trade what the charts are showing, I guess. Leave my biases at the door. If I didn't get stopped there, move down to VWAP probably would have been nice. SPY. Reap, reap. Didn't really see another good entry to go long, so it's okay, it's okay. Ah, wait. Aloha, Maui. Tesla getting a little pump here. Yep. We got WeWork up 25%. Did you guys see Liquor with a little pop pop? Still doing it? Oh, this thing's volatile, man. Figuring out where it wants to trade. Good though. I average down. I don't know. It'd be easier to get out if I want to get out. If I just double down right here. I think I'm down like 30% now. Yeah. Good. A nice little inverse head and shoulders maybe for me. Barbecue's down 4 still. Got GME down 3.7. GNS is up 17, holding up well. Little bounce around RAD up to VWAP. Up what we're doing. Up's down 6.7. Also nice bounce on that 50% retracement. $3.20. Pretty big break here on SPY, really. Got that break. It started to. And on Friday, started to show this kind of horizontal channel. Now today, it's starting to show real reversal. Starting to build kind of a big cup here, potentially. boy, still going. What's this yield at now? 16.3%, still pretty steep. Still pretty steep there, IEP. Well, GameStop's had a pretty nice bounce. GNS holding up well right at VWAP. VWAP. Staying below VWAP. Up, down 7.6. Seems like it should. I guess it doesn't have to. It could dig a little deeper. 61.8. Be nice if it held this. Held this, I suppose. We're just now getting a crossover on the MACD on the daily. Eh. Or is the price of AMC and Ape gonna have to converge? Meaning Ape's gonna still keep coming up and AMC's gonna still keep coming down? I mean, the news is kind of bullish on AMC as far as the company. They need liquidity. Right? So that's what they're doing, is they're offering up shares. Sucks for shareholders. When is the 22nd? I keep forgetting, it's the 22nd or the 15th. The 15th is OPEX. Okay. Barbecue down 6. GME popping up there. Very nice little bounce on GME. GNS above VWAP now. Yeah, I might get some more. I might. It's holding above Friday's high even. Okay, I got some more GNS shares. Did it. SPY just melting up here. And more. GNS above VWAP. So it's about to break. There's a break on GNS. Do it. Nice. 32%, 35%. Geez, that thing just flashed to $1.70. Holy crap. That was crazy. See if it makes it even more aggressive channel here. Alright, climbing up more. Should have held just a couple little runners on SPY. Oh well. Liquor House is up 15%. I have not averaged down on this, but looks like we're finding some buyers here. That was a crazy spike on GNS. Let's see what we got. I think $2 is really the next. I think that's the next go. Yeah. At 201, $2. Oh, we're going there. Too high there on SPY. SPY's ripping. Those contracts would have been like 1,000%. Barbecue back to VWAP. Be just flattening out here. GME had a pretty nice bounce off the lows. Still down 2.3. Ah, AMC's moving up a bit. high, new high of the day. GNS pushing up there, $1.62. Liquor's up 16 now. Sending out data farm members on the YouTube membership. Send out a play. Just opened up another one. It closed any. I've been pretty heavy in more the cash balance, I guess. I haven't been opening up a whole lot just because of the market. It's been pretty toppy. We had all the data last week. So just treading softly. Taking opportunities where I see them. Now that the catalyst, some catalysts pass, like earnings and stuff, you're just more in the clear. A little red candle here. Liquor's up almost 20. He's down 2.5. Barbecue down 7.7, so kind of interesting. Yeah, GNS kind of breaking out of this channel a bit. Maybe we start to make a more aggressive trajectory. Nicola's down 11. I just saw a video. Test drive around the Nikola semis they have. Actually came out and I've made a lot of semis. Oh, Groupon popping up there. RAD still below VWAP. Charge points down 0.5%. SPY's coming down here a little bit. Dude, the spreads on GME suck. Liquor 26%, getting to yesterday's high. GNS still going. 41%. Back up to $1.70. Goes. Making a more aggressive handle now. Yeah, MC. I don't know. I don't know if it'll fill that gap. Lots of weird stuff going with AMC. I don't know if they have to. The prices have to match. APE has to come up more. AMC has to come down more. Yeah, like the arbitrage play, I feel like it's mostly over, but the prices haven't equalized, so it's not. eBix got dumped on. pure retest in the highs from yesterday's rip. GNS just climbing on up, 44% today. Awesome. Why I ever took profits on this thing? Just kidding. I think it actually worked out in my favor. I took profits here, then bought back in some here, and bought back in the rest here, basically where I took profits. So it ended up working out overall. Sometimes it doesn't when you're trying to time the market so often, so much. It's just like when I'm not trying to like actively trade this one on a swing. My position now is larger too than it was for this run up to $1. Still not crazy, but yeah. So SPY's come down a little bit here from the highs. It's just down 3.7. Their earnings. Oh, November. They had them in 8.8. Why didn't it show it on Webull? Picked up some SPY calls there. We kind of hit a resistance up here. Not sure. We'll get a double top or we'll break through there. Just kind of a pullback, bull flag. What I'm hoping for. Like GNS is staying. Or no, I made a new channel. So looking good though. Liquor's halted to the downside. A tiny flow. It's only a million shares. GME down 2.45. Barbecue doing down 6. GNS, nice consolidation on the breakout of the resistance. Yeah, liquor's halted. It's a tiny float, so got close to that high of yesterday and halted down. Back to VWAP. It halted yesterday or on Friday also when it was rallying. Yeah, I'm out of those calls. That might be too tight. Clickers resumed. VWAP. Excuse me. GME coming down a little bit. It's down 3%. Barbecue back down 9.25. Vickers is up 7%. GNS holding 41%, 42%. Next stop, $2. Miss Fresh popping. Yeah, they'll pop on Miss Fresh up 6.5. That's consolidated nicely at the highs. Hmm. %, on GNS. Nice bull flag up above the breakout. 195. Yeah, somewhere 195, $2 in that range. Alright, let's see if it's going to bounce here. We get calls, or if we drop, it's kind of a make it or break it spot. We have a head and shoulders on the SPY. Should we either break the neckline or we're at the buyer's spot. Alright, looks like it's long. Excuse me. Barbecue down 10. Back to the low of the day. Breaking through $2 today would be a pretty big Monday. It's already up 40% GNS. Barbecue's flushing down 14% now. Whoa. Not good. 16%. Yeah, that's not good. Looks like it's working that back as resistance. GMS is the same, maybe false breakout did back here with little head and shoulders. There's our head and our shoulder. Yeah, I don't like that it respected that as resistance again. I flushed through yesterday's lows. bounce there, 10.5. Maybe it's just a trigger, stop loss trigger hunt. I'm not sure. But yeah, I close back out. I don't like the break of that support. I don't like the resistance still being respected. Could still be forming kind of a bottoming. This cup on barbecue. Wait. BNT up 1.5. There's SPY bouncing a little bit. More consolidation on GNS. A reversal? Maybe. See if we get a double top. GNS is here to save you. Yeah, I mean there's catalyst for another squeeze on GNS. Potentially larger, because this is share count and everything. All of this was just in anticipation of what's coming now, which is the share recount and the dividend. So we'll see. Potentially a lot of the major shorts closed here, but not really a way to tell. Or there's just a hype run up. But, I mean, there is going to be a share recount for this divvy, so. Okay, I'm out of those calls. Liquor's holding up 8.5%. I've got GME down 2.6. Barbecue. Back to VWAP. So kind of an interesting flush there. Not liking it though. Not liking it. Want it to hold above here and really break out of this resistance. Could still do it today, I suppose. But the fact that we broke through support isn't a great sign. Actually hit right near where that thing flushed. And then did its little head and shoulders. So continues to use this as resistance. I think we're headed back down to 1750. I just chopping around. Are we down 11.3 GNS? Up 38%. Dish is down 2.85. RAD still hanging out down 8%. $11.36. We just had an EU market close. Got 19 likes in the day. Thank you guys for the support. I appreciate it. This fresh is up 9%. GNS consolidating up here.
zero emissions without a technology like net power.
And I just want to talk to you about some of the volatility that we've been seeing in natural gas prices. Of course, 2022 was a big year in terms of nat gas. I think it was up something like 40%. It had been under pressure this year, but then more recently we saw a huge uptick in prices on the heels of some news out of a potential strike in Australia. We were reporting on that, I believe, last week. How does that volatility impact your business?
You know, it really doesn't impact our business. I think when we look at just the market opportunity for net power, the largest and most attractive market is the United States. It's where we have the access to the lowest cost, most stable price of natural gas, thanks to shale development here in this country. You know, the United States is the largest producer of the lowest cost gas in the world. And on top of that, we also have the most storage capacity to be able to permanently and safely sequester CO2. And so when you kind of put those two together, the United States really just stand out head and shoulders above every other country. But I think it certainly just continues to just reinforce the importance of where energy security plays and the reliability of that energy plays into the future energy mix. I think, you know, while I think everybody is very focused on decarbonizing and getting to a clean energy future, unfortunately, you get these stark reminders every once in a while, like what you're seeing in Australia, where all of a sudden energy reliability at the end of the day becomes the most important factor in selecting what energy we're going to use.
All right, we'll leave it there. Danny Rice, good to see you again. Thanks so much for joining us. Coming up next, it's time for the Disruptors. George Tillis is focused on Okta, which just got an upgrade from Goldman Sachs and is trading higher to kick off the week. We've got an example trade after the break. Stay with us. We'll be right back.
Probably down 10 a quarter. I still chopping around here a bit. Potentially have a little inverse head and shoulders being formed here. Head, shoulder, another shoulder, and up over here. The same trade. I was trying to get in back here, but hopped around. I got out. If it's ready to move, still pretty early. It's only 11:45. Lots of day ahead of us. Test of the high of the day. Probably take some profits. The longer time frame, it does look like it's more bullish, looking like it wants to at least test the top of this channel it's been in, if not break out of it even. So not to have bias, but did show a nice bounce on this prior support. No bias, so it could be shoulder, head, another shoulder over here. Actually flush through that low. Right now we're kind of just in the middle of the range on that hourly chart. Barbecue down 12. GME holding up pretty well. It's down 2 1/4. AMC's down 33. The GNS moved back down to VWAP, up 33. RAD flat at VWAP. Fish down 3. Charge points up 0.5%. Up, green 2.5. So nice little test again there on that 50% retrace. 32, $3.20. A little gap to fill up there. Runs up 1.6. Buys climbing up some more. Base is down 2.6. Buy testing the highs. Sold 1. There's new high on the day for SPY. Little cup here for SPY at the high of the day. GNS is going to keep going to the right, TJ. I don't know. It's up 33%. Chart still looks good. Hasn't shown the top at all. Hasn't even showed much of a retrace. Had a little retrace on Friday. And yeah. $2 is the next resistance. But even that's not super major. Looking for pullbacks to go long on, really.
School season, right? So how should Target fare in this report, and what sort of guidance are you expecting to hear from Target?
Yeah, I think the keys are exactly what you mentioned. You know, Target over decades has built a reputation as a great place for trendy, pretty good price, general merchandise, right? Apparel, home electronics, household goods, so on and so forth. And right now they're actually battling that reputation because consumers are holding off on their spend on non-essential items like that with their limited discretionary dollars, especially given that people are traveling more, they're going to Taylor Swift concerts, so on and so forth. So they're really not buying that kind of stuff. Now, will that change with back to school? I sure hope so for Target's sake. I think their keys are one, winning back to school, and two, continuing to hammer the fact that actually half of their assortment and half of their sales are coming from essentials, from consumables, food, grocery, center store. And they have some very good private label brands that offer actually a great value proposition to the consumer. So I think, they're kind of really trying to right the ship, and hopefully back to school gives them the boost they're looking for here.
Yeah, good point about the Taylor Swift concerts, but they have to get outfits for those concerts, and they might go to Target, although I'm hearing a lot of good things about Walmart's clothing lately, so maybe they'll be a beneficiary as well. But Chris, let's shift to Home Depot, because we're obviously in this high mortgage rate, low inventory, multiple headwinds in the housing market in terms of affordability kind of picture. Should that help or hurt Home Depot?
Well, I mean, I think in the near term, lower turnover is probably a little bit of a headwind. The fact that people are lapping a period where they've done a lot of projects is also a headwind. But we think longer term, when you look at the fact that the housing stock is, in the U.S. is as old as it's ever been, 40 years plus, and that there are a lot of people in the U.S. who aren't going to move. They're going to be snug with their sub 4, sub 5% mortgages, and they're going to fix up the home they have. So, I think once we get to the intermediate term, I think that's a very bullish sign for both Home Depot and Lowe's.
Emerson, which companies are most vulnerable heading into this reporting period?
Great question. I think this particular short-term period, Home Depot is probably going to, have the third consecutive quarter with a decline, but I totally agree with Chris. I think long-term, also bullish on Home Depot. And I think Target is... it's going to be really interesting. I'm relatively, concerned about what the results are going to show for them.
And Chris, which one would you avoid most heading into this earnings season?
I don't know that it's an avoid. I think it's a question of, what are you prepared for in terms of the long term? I mean, one of the catalysts for Target is that Bed Bath is out of the back to school business, which should help Target. I mean, I think the counterpoint on Target is when you visit the stores versus visiting Walmart. I think Walmart has been a little bit more aggressive on low price points and entry price stuff, particularly for the back to school market. So I think that's the trade-off there.
And I think it's also important to note that Walmart's up 13% year to date, whereas Target is down 12% year to date. So the bar maybe is set a little bit lower for a company like Target. We'll have to wait and see. Chris Greya, Argus Research, Emerson Delgado of McMillan Doolittle, thank you both so much for getting us ready for those earnings. It's going to do it for Trading 360. I'm Caroline Woods. Fast Market is next.
Glad I cleared that up for you, TJ. Hey, it's me. Has it been a long time? GNS? It's another stock. Another ticker. Very squeezable. Barbecue down 10.3. Buys, maybe making a double top there, or it could still be a cup and handle. Wait and find out if it finds support. RAD hanging out at VWAP. Liquor spec red. So, not too uncommon for a recent IPO to be volatile like that. Had a nice bounce off of $2 and has a nice bull flag going on now, so like a temporary low at least is in. No, I was here. I heard him. He said Target should do better with back to school now that Bed Bath is out of the way. Not much more bearish news you could hear on Bed Bath. But I mean, they're not away. Overstock has them still going with Overstock. So yeah, I'm sure he's not super well versed on what's going on with it. GME still making new highs, new high in the day there, close to it. On 1.8 now. How did SPY just make its handle? Good bounce on barbecue from that flush we had earlier. It's back to VWAP. Sort of. Almost.
While retail sales data from July is also due tomorrow. Now let's take a look at those four major indices. The S&P 500 up 0.4%. The Dow Industrials barely in the green, and the Nasdaq 100 tech leading upside, up 0.8%, and the Russell, Russell 2000, the small caps, down nearly 0.5%. To help me break down this market action, let's bring in my co-host Kevin Hinks. Kevin, you know,
Like he had some pain behind those
quite a rebound
eyes
here today, but I think it's on the back of maybe that weakening dollar. Yields kind of turned around a little bit. What's your take here on the market action?
Yeah, hey, Tom, pretty resilient market so far today. I think, you know, I've been talking with Ben Lichtenstein this morning, Oliver Rinnick this morning.
Lichtenstein.
And there's a lot of issues going on with China, and you see it in the Tesla price reduction. There's a lot of things out there, but if you're going to sum up this week, Tom, if it's a chapter of a book, it's retail sales and retail earnings this week is going to tell the story. And there's some fun stories out there to tell, like the big difference between Walmart's chart and Target's chart and how to look at those. So what is that going to play out throughout the week? Data, other than retail sales tomorrow morning, we've got some housing, we've got some regional economic data. All things considered, though, Tom, this is a market, but me personally worried about, you know, as a trader, this whole China story, it doesn't seem like it's getting any better, Tom. You know, there's bits of good news coming out from China, like some of the casino stocks, some of the other, but boy, the rallies aren't lasting very long in China. And so I'm watching more price cuts from Tesla that we're going to talk about. This is a resilient market,
yeah.
though, up 0.4% at
pain
midday, Tom. I thought,
eyes.
frankly, it wouldn't be this
You know
strong,
what the best
but it is.
cure for pain is?
Kevin, when you look at
Weed.
the China
any?
story, you know, the rebound in there in that
Yep.
country has not been as resilient as a lot of people have predicted at this point. Today, you've got the Chinese real estate company Country Garden Holdings continue to tumble after you know, they suspended trading on 11 onshore bonds. I mean, this is kind of reflective of the strength that you know, that everybody was expecting. It didn't come, but at the same time, is this setting us up for maybe some more monetary policy changes in China that can lift it? Because I think a lot of people are betting on that. That
GNS
the
bounced a little
you
bit.
know, the government's going to be more supportive moving
37%.
forward.
And there it is, Tom. Doesn't it feel like the U.S. markets are trading like they fully expect China to stimulate their market, and they're waiting for the after effects of the stimulation? They're almost, you know, putting that into our markets. Oh, China's going to stimulate. So, you know, we're getting ready for when they do that, because, you know, China has got some disinflation. China's got some property issues, you know, with they've got some hedge fund failures. They've got a lot going on right now in China.
Tomorrow, is it?
And whether we want it or not, Tom,
I have a mark here for the 18th.
U.S. economy is
Friday.
dependent on China. We are
Going
linked.
tomorrow?
We can never decouple. We talk about de-risk, but the odds of that going, you know, full tilt are not high. There's always going to be a strong relationship between the U.S. and Chinese economy. And so we depend on them. And if they have problems, it should come over to our markets as well, Tom. So, yeah, with China and Japan down big overnight and us holding on to some gains here, surprising, frankly.
Yeah, we'll get to more clarity on demand. Is China's economy not as robust as everybody thought it was going to be due to demand across the globe for products? We get a lot of retail earnings this week that'll kind of give us a glimpse into that. But you mentioned Tesla earlier, Kevin, cutting more prices over in China. I know that their margins are high, but at the same time, is this a demand issue or competition issue? Let's bring in Kevin Green, senior markets correspondent here on the network, to help us break down this story. Kev, you know, more price target cuts over there. It seems like the competition's really heating up. What's your takeaway here from the Tesla news?
Yeah, Tom, we thought it was over when it came to Tesla cutting its prices, especially after margins declined in the last quarter. But that seems to not be the case at this point in time. It actually looks like they are offering a $1,100 incentive for certain Model 3 cars, and they are also cutting the prices on its long range and
Mohammed, there might be a
Model
hearing tomorrow too.
Y
I'm
vehicles
not
as
sure,
well
honestly.
by around
Have to just look at the
$2,000. Now,
schedule.
this is right after another competitor also cut their prices a couple of days ago. So we continue to see this price war, and it's starting to be reflected in a lot of these stocks. Tesla's down 2%, but it has come off the lows. We are seeing NIO down about 4.5%, Li Auto down by 2.85%. Now that could be because of these price cuts, as well as some of the economic data that you were talking about earlier when it came to the real estate issues in China, as well as some of the other areas of the marketplace that has been has seen some softening here. But when you're looking at the EV space, demand is still there in China. If you look at it over a year-over-year basis, battery EV vehicles actually increased in July by 23% on a year-over-year basis. And according to Citi, hybrids and battery EVs actually made up around 36% of all of their new car sales for the month of July. One thing to note, sometimes we see this combination between pure electric vehicles and hybrid vehicle sales kind of combined together in China. And the reason being, a lot of those hybrid vehicles are in highly densely populated areas. So even though they are hybrid, usually the person that's driving them does not actually have to utilize a lot of the combustion engine side of the car, which is why they kind of lump those numbers together. So demand is still there, but it's because of these price cuts. Let's see if China's going to be able to kind of get their consumer out of a rut here when it comes to some of the other areas of the marketplace. But I think Kevin hit it on the nose. When you're looking at China, they're so linked with the United States and vice versa. What are they going to be able to do? They're going to have to spend money if they want to cut their currency or want to try to devalue their currency even more. We also have to kind of keep in mind, I mean, they have a significant amount of treasury holdings. So treasuries prices are already down. You cut the value of your currency, that also devalues that treasury holding. It's kind of a domino effect. So we are going to see if they're going to spend themselves out of this. And if history serves as a predictor for the future, most likely we probably will see some aggressive action by China over the next couple of months.
You know, Kevin, you have to hand it to Elon Musk. When he sees weakness in data or he senses a weakness in an economy, he goes right to the price level of his cars. And the good news is for Tesla and Tesla shareholders and Tesla traders, he's got room in terms of margins. U.S. auto workers, they don't have a lot of room in terms of margins. So Elon Musk can cut, but Kevin, the question is, how much do you think he can cut? How much room does he have to bring down margins before it does start to hurt? So far, you know, his cutting prices, both in the U.S. and in China, have worked, right? And he's gotten the sales to make up for it. And his margins still remain at fair levels. But eventually, if he has to keep doing this, it's going to start hitting bone, Kev.
Yeah, definitely. I think that's the biggest question here, because when you look at the margins that Tesla has, right now we're looking at around 18.9% when it comes to operating margins. Compare that to a Ford or GM, they're probably sitting at around 7.5%, which is typical for an automaker. Once you start going below that 15, that 14% level, Kev, that's when you have to start asking yourself, how much is it worth the premium for Tesla stock? Because that's really what's been the growth driver for them. But you're also going to hear from the Tesla bulls that it's not so much about the car sales in itself. They could really sell them at cost, quote unquote. That's coming from Elon Musk, because the full self-driving features that's going to be able to open up a lot of opportunities in the future is going to provide a lot wider margins for this business. And they think that that's going to be obviously some recurring revenue. And that's really what they're shooting for. I think it's kind of a little bit of a hybrid approach. I also believe that we are seeing these cost cuts coming in because their expansionary strategy with these giga factories in China and Germany, you can't build out a factory and then not produce cars. So they also have to kind of keep that in mind too. They want to be able to reach some production targets because they're, you know, the cat's a little bit out of the bag. They're committed to this price war. They committed to this expansion strategy. Now they're going to have to see it through. I'm not sure if they're going to be able to turn it around and treat it like they were, where they were just like a premium brand out there that people would pretty much pay any price to get into a Tesla. It doesn't seem like that's the case anymore.
Yeah, I think it's all going to be about demand at this point. And to your point here, Kev, I think the OEMs on here, as far as the legacy automakers are going to probably take some pain because they have a UAW vote coming up soon too, so that might come into play as far as wages go. So we continue to watch this story. Stock down over 2% today, and thanks to Kevin, markets correspondent here, breaking down the Tesla story. Kev, I'm going to go back to you here.
Coming down a little bit.
It's all about the consumer this week. Bank of America came out with a note. They're now bullish on consumer discretionary, upgrading the sector to overweight from underweight earlier today. It's kind of, that whole theme that we're not going to go into a recession. The consumer remains resilient at this point. Is that what we have to put, the back of the markets on at this point, the equity markets? Because we pulled back quite a bit here in August, a little bit of a rough patch here, and historically, August is one of the months that doesn't have the best returns. Is this what we have to rely on moving forward, that the consumer is still there because it's so ingrained in the economy?
You know, Tom, it's tricky as we move from sector to sector in earnings
season.
Down a bit. Now, historically, the second half of earnings season has a lot to do with retail and the consumer. And we're going to get Home Depot and Walmart and Target. And can Target get the margins back to a reasonable level? Are they through a lot of that inventory? What about Walmart? Are they going to be able to put up the massive numbers? Home Depot, Tom, that stock had some weakness, but a massive recovery the last few months. Have they gotten ahead of themselves, or is Home Depot starting to recover? So there's a lot of questions about the U.S. consumer. And like I said, we're going to get retail sales tomorrow as well. So, this is going to be a fun week, but it's different, right, Tom? It's different than high cap, large cap tech. It's different than airlines and financials and some of these other companies. The Magnificent Seven, they're all out. They're all correcting in a way. All their charts look like it, but boy, a lot of stocks, Tom, at or breaking through their 50-day moving average on a chart, and there are some big gaps between the 50 and the 200-day where some of these stocks have run. That makes the whole market, in my opinion, a little dicey if you start getting in between those two. So, there's a lot going on here, obviously.
Yeah, a lot of execution issues on some of these retailers versus some of their peers. Walmart got added to a tactical outperform. Again, we've seen price target hikes across the board over the last month. Everybody seems to think that Walmart is going to blow out their results later this week on Thursday. We'll have to wait and see on that, Kev. But when you look at this, one of the stories that came out today was Goldman Sachs stating that they expect, some interest rate cuts by the Fed by the second quarter of 2024. I mean, the Fed keeps pounding the table that, hey, maybe they will pause again in September. There's only about an 11% chance, according to the CME FedWatch tool, that we're going to get a hike. But if you look at this note from Goldman Sachs, they think that, they're going to start cutting rates in the second quarter. Does that kind of signal that there might be some other issue out there that we're not, seeing at this point? Because the Fed said they're going to keep rates where they put them longer than you might expect.
Yeah, Tom, forgive some of my skepticism, but there's always a risk 6 months out of a recession, right? I get it. What I would like to hear Goldman Sachs say, and full disclosure, I'm an alumni of Goldman Sachs, where do they see 6-month inflation 6 months from now? Because if it's only slightly above 2% or at or near the target, well, yeah, I can see Jerome Powell easing interest rates. I don't have a problem with that. That's realistic. But I just, these people that say, in the next 6 to 9 months, there's a so chance of a recession. There always is. At every single moment in the market, there's a 6 to 9 month chance of a recession. So I'm a little skeptical of that. But, Goldman's been making some aggressive calls. They put an $86 mark on crude oil a couple weeks ago. That's playing out pretty well for them. But I still think this one didn't get my attention as much as the crude oil call that they made a couple weeks ago. But listen, Jerome Powell, you can always have some event, Tom, that could make interest rates go down. You can always have Jerome Powell getting closer to the target of 2% that could force Jerome Powell to ease or allow him to ease slightly. But, that wasn't a catastrophic call for the overall market. There's always a chance obviously. So, yeah, I get it. It's a call, but it's nothing that really caught my attention, frankly.
Yeah, and remember, they said back in March that the Fed was done hiking then, got a couple hikes post then. So to your point, they can be wrong, and they have been before. Kevin, real quick here, one last question about the dollar and rising yields. So we're at critical levels. Dollar hit 5-week highs before pulling back here a little bit. Is that the outlier here? If we continue to see those two rise, I mean, what parts of the the market do you see taking it on the chin? Because so far it's mostly hit the tech space at this point. Yeah. But we've got the Russell down a little bit. But if we see those continue to rise, break through these levels. I mean, the 10-year was at above 4.2% earlier today. If we continue to see those rise, where do you see equity markets heading?
Tom, I think traders, investors, they get distracted by so many things going on. And what they should do is look for what's going on in the world and its effect on the U.S. dollar and its effect on yields and its effect on crude oil. And if you stay with those three, let all that noise play out, the bottom line is the dollar has risen, yields have risen, and crude oil has risen. All those should work against profits and ability, expenses in companies. I think that all works against stocks, but not so far today, Tom.
Yeah, that's right. We have seen the dollar pull back from the session highs, and now yields a little bit lower, that 10-year, but back below 4.2%. All right, Kev, let's take a quick break. When we come back, we're going to take a look at Home Depot. The home improvement retailers bounce back pretty sharply this quarter and reports earnings tomorrow morning ahead of the open. Fast Market's coming right back.
I sold some of those puts for a profit. I'm going to just do my stop. Hopefully I don't get triggered. Just let them ride. Probably about to get stopped out here though. All right, markets. Looks like it's maybe starting to roll over. SPY's coming down some more here. We've got VWAP.
Coming up with some ugly comps, but that being said, Home Depot, this is the gold standard in home improvement retail. So they're the leader in this industry. So I'm going to watch Lowe's, how it trades off Home Depot's numbers. I'm going to watch Home Depot because this is a pretty interesting earnings that we're going to get. Why? Well, because, like I said, are they making money off higher prices? Is their volume starting to pick up? And this stock has run a long way, as you know, Tom.
Yeah, and their sales were down. It was on the back of extreme weather, late start to spring planting season. So maybe that had some lag effects, and maybe that'll show up in these earnings where they're going to beat estimates. But they're still expecting those comparable sales down anywhere from 2 to 5% from the company, as they stated last earnings. But Kev, when you look at this stock going in to trade it, implied volatility pretty elevated at this point. How do you want to look at this one?
Yeah, this is one, Tom. Like I said, they may put up some good numbers, but the stock has run a long way. And so we've seen that in a lot of these names. Which way is it going to go on their earnings? If they beat, if they beat for the same reason they've been beating, which is higher prices, the stock reacted very negatively to that in the past. So Tom, I went with the double calendar, which means I looked at the expected move. And I think it's about $11. Yeah, right at $11. And Tom, I went from where it is right now, about $329. I went to the 340 call calendar and the 315 put calendar. A little further on the downside. Why? Because if they do miss, this stock's been higher, and you're trying to pinpoint where this stock might settle around a strike price. On the upside, I'm pretty in line with the expected move. A little more room on the downside there, Tom, as sometimes stocks move lower quicker and faster than they do on the upside. So, yeah, the 340 call calendar, the 315 put calendar, trading right around $1.60 for both those, Tom. So relatively inexpensive. Why is that? Well, if you look at the implied volatility, 44, almost 45 in the front expiration, down to 32 in the second expiration, Tom. So a little bit of advantageous there, finding the edge in this trade where the front implied vol is making the calendar spreads relatively affordable. Doesn't mean you're going to be profitable. You want to see a move towards those strikes, Tom.
Yeah, let's break this double calendar position down here, Kev. Out in the August 25th weekly cycle, so 11 days till expiration, buy the 340 call and buy the 315 put, both out of the money. And then in the near term, the August 18th monthly series expires in 4 days. Sell that same 340 call and 315 put, paying roughly, we've got a $1.55 debit. The debit that you pay is your risk on this, so $155 per spread. You see those break evens, though, they're pretty wide here. 304 on the downside and 353 or so on the upside. Those might tighten up a little bit due to the fact that implied volatility historically falls after earnings, and it'll fall in that option series that you bought the options in also. On this one, that one standard deviation move that Kevin mentioned hits it on the downside, maybe a little bit light on the upside, but this is a type of strategy that you're picking to take advantage of what Kevin stated, the divergence between implied volatilities, where you're buying a cheaper implied volatility on an aggregate basis than what you're selling in the near-term options on this. You do have some assignment risk on those short options that expire in just 4 days, but the whole idea here is you don't have to pick a direction. You just want it to move closer to either strike, and that's where the apex of profitability
back to teaching, yeah, school started, that's
you
true.
Don't want
all right, CDB, good luck, man.
2 standard deviations outside
maybe
of those,
most likely
strikes,
not.
To the downside or upside, but also you don't want it to kind of just sit there a little bit. But you do have 4 days until expiration on that one, and time decay or theta works in your favor on this one. Positive time decay as your near-term options that you sold decay at a faster pace than the options that you bought. So a good look at the double calendar strategy here to take advantage of a move, but you don't have to pick a direction on this one. All right, Kev, that's going to do it for this segment. When we come back, though, we're going to be joined by Lightfolio for a discussion on holding the athleisure athletic wear. They started with shoes, starting to branch out here a little bit. Stocks up nearly 100% so far this year. We'll get some data out of Lightfolio when we come back.
Bounce around SPY. What does it show? 60%? I don't know. I'm not showing 60% on BBIG. It looks like it's delisted, suspended on Webull. DWAC up 1.5.
As much as we used to be on these earnings reports, I can remember some scores in the really high double digits on this one, and we made some really big trades on this stock. Now we're closer to neutral on it because it's this. I think a lot of the growth is getting priced in. Everyone knows that this company's doing really well, but based on the pullback, I'm still bullish, and I think this pullback does give an opportunity for earnings tomorrow.
Landon, this is a Switzerland-based company, and I just got back from Europe, and I can tell you these shoes were everywhere throughout Europe. Now, I'm a gym shoe guy, and I'm a shoe guy in general, so I'm always looking at people's shoes and what they're wearing, and I can tell you Europe is full of these shoes. So, the question is, are they, when do they hit critical mass? When are they really on the map? Because are they bigger than Under Armour now? I know they're more popular. That is, but when are they a real competitor to Nike? I mean, obviously Nike's the gold standard here, but I get how popular they are. I look at the shoes walking around towns. They're not cheap, right? You can't get them for nothing, but they're incredibly popular. But when does this become a name that you're guaranteed to see long term?
I think it's tough. I mean, I think they've got to they continue to branch out. They've got to, they started in running, track and field, that kind of thing, getting into tennis shoes now. So they're getting in athletics. I could be mistaken. I don't think they have anything in basketball yet. And that, I don't know if they're going there. It doesn't seem like a basketball shoe to me, but maybe if they get there, then you might turn some heads and Nike would start to, be a little bit threatened. I don't think that, when you talk about Nike versus OnCloud, I mean, this is two different classes of companies, and OnCloud is on the way up, huge potential, a lot of momentum, growing very strong, but then they're nothing compared to Nike right now, but they're certainly on their way. I will tell you, if you've ever put these shoes on, they are unbelievably comfortable. I mean, you put them on, you actually notice how soft they feel, and you understand why they're called OnCloud. It really makes sense. The downside / upside to this, and I'll explain what I mean by that, is I think that they tend to get less comfortable over time, and they don't last really long, but they've got like subscription plans. I know that Megan has, our VP of research, she has a subscriptions
for
she
shoes
runs so much where she just gets a new pair shipped to her every 6 months automatically because she wears them out so much through the running. So she's buying new shoes automatically every 6 months to this company. But every time you put them on for the first time, that new pair, you're like, oh yeah, this is what I wanted. Like, this is so comfortable. So they keep people coming back. So it's kind of an interesting product. They're not made to last years and years, but every time you put a new pair on, you love it. So I like where they're positioned. I don't think that they're a threat to Nike just yet, like as far as overtaking Nike, but they're certainly taking market share away. And every time, like I said, every time they get on a podium or every time someone wins something where they've got these shoes on, it's just kind of, turning heads and making everyone who watches that sport or everyone who wants to be like that champion say, maybe I could be 2% faster, 2% better if I had these shoes. And that's only going to help sales.
Yeah, Landon, I compared this to two different companies. Not only, you mentioned Nike, but at the same time Lululemon, because they started out as a shoe company, right? And they've expanded into apparel and accessories, right? And Lululemon is attempting to do it with their shoes. Those haven't really taken off. Is that the end for this company where, they can continue to grow, 50% on a year-over-year basis as far as revenue goes, just because of that fact that they're getting into other areas and the margins on their direct-to-consumer are a lot higher. They're not in a lot of stores. They're in some higher-end retailers. So is that the end for this company where they can just continue to expand their athleisure wear, and that's going to help them down the road even more because they started out as a shoe company?
I think that's a really good move for them, but they've got to be very careful. They have to make sure that the quality that people are used to translates into that athleisure wear. You can't have a drop-off. It's got to be 100% premium. It's got to compete with Lulu when it comes to look and feel because that's the way their shoes are. People have this going in, when you ask someone who wears OnCloud shoes about how do you think their athletic wear will feel, they're going to have very, very high expectations. You can't miss those expectations. It's going to lead to easy sales when people say, oh, you know what, I'll try out their shirts because I love their shoes so much, but you got to keep that up. Otherwise, the entire brand suffers. So it's a little bit of a, it's a risk-reward play. I think it's obviously the right move, but they've just got to make sure that they keep the quality top-notch because that's what's going to bring the customers in from the shoes, and that's going to keep their brand reputation extremely high.
And you mentioned you guys have been positive, for a while on this stock. It's finally caught up to your data at this point. But going into this earnings, do you have a score with it running up 100% so far this year?
Yeah, so officially we're at plus 15, which is just under the threshold for a bullish bet. That score was published on Friday. I would say with the pullback over the last little bit here, I would say that we might be in that range where we're willing to take a bet on the upside. It's not hardcore like out of the money calls or anything like that, but if I have to bet whether this thing's going up or down, I feel comfortable betting to the upside.
All right, great stuff, great data as always, Landon. Appreciate it. Have a great day.
Thanks, guys. Take care.
All right, Kev, you heard it there. Even with the run up, but we got a little bit of a pullback here so far in August. How do you want to look at this one from
RAD, barcoding
an example
to
trade?
flushing.
Because if you look at it on percentage basis, the move they're expecting, it's about 13% either way.
Yeah, and Tom, what I want to do here is use options to put on a diagonal spread or stock replacement that allows you to be bullish in this name for a fraction of the price. Now, what I did, Tom, I went out to October expiration. So that is October, about 67 days, more than 2 months, Tom. And I bought the 32.5 call, just about $1.50. What is it, dollar? Yeah, almost $2 in the money, Tom, at 32.5. Then I went out to this week, the earnings event week, and I sold the 38 call in line with the expected move of around $4. So I've got the 32.5, the October 32.5, and then this week, 18th of August, 38 call diagonal, Tom. And that gives you, about 36 deltas, Tom. So it's in the calendar spread family, but it's a much bigger delta. You've got basically a $5.50 diagonal on, so you've got room on the upside for this to move up towards, and you've got time, Tom, to extend duration on this trade and chip away. You're only spending $3.70, Tom, and you've got $2 of intrinsic value, so not a whole lot of premium in this trade, Tom. Collecting about $20 a day in theta. Obviously, you're looking for a move towards that $38 strike, Tom.
Yeah, let's break down this example trade Kevin's bringing us. The October 32.5 strike call. It's about a 65 delta. So as Kevin mentioned, kind of a stock replacement type of strategy here. We got that higher delta call that reacts more like the stock. And then against that, selling the August 18th monthly, the 38 strike call, paying roughly, we've got 360 debit. It might be about a dime higher than that. But if you pay a 360 debit on that, there's your risk, $360 per spread. As Kevin mentioned, it's $5.50 wide call diagonal, so you're paying much less than the width of those strikes on that. You do have that ability, as you get closer to expiration in the next 4 days on that short option, you can adjust or roll that if the market's open, liquidity is provided. That creates credits, reduces your exposure and risk on a position, and increases potential profitability. But you can see there from the risk profile we've got up, you want the stock to kind of grind up towards that 38 level over the lifespan of this trade. You do have 67 days until expiration, until October expiration on this one, so plenty of duration. Also, even if the stock does pull back post earnings, then maybe rallies back, but definitely a bullish strategy that we're taking a look at here. Kev, final thoughts on this call diagonal here and on holdings for some upside exposure, and you're actually taking advantage of that divergence in implied volatility on this one too.
Yeah, this stock only trades $34 and change, Tom, so you could just buy the underlying here, but that's $3,400. This is about $360, $370 that you're paying. So still, even though this is a low price stock, options still work to greatly decrease the overall investment that you make from a dollar perspective. So a less expensive way to play an upside move in on holdings.
And you definitely have some risk
GNS
on that short 38 strike call that expires in just 4 days.
Volume there,
expiration
17,
on that
18.
one also. So keep that in mind if the stock does pop above that level. All right, Kev, let's take a quick
3%.
break here. When we come back, we're going to take a look at Apple, which is up about 38% so far this year. But it's down about 8% here in August, taking a little bit of pain. Fast Market's coming right back after this short break.
The yields continue to climb up. See?
This year, we saw what happened in earnings. The stock's been sliding over 8, nearly 9% so far this month. Is this one? It seemed like earlier this year, as the stock was rallying to those all-time highs, it got a kind of a pass because they kept on expecting, Apple's revenues to decline. They declined 1% last quarter, third quarter in a row. But it seems like it's gotten a little bit of a pass due to maybe the healthy balance sheet, cash on hand. Give me your take here on Apple.
Well, yeah, this is a situation. I mean, this is always the case, I think, for Apple, where you can't really compare the company to any other company because there's no one you can essentially say they're mainstream competitors when it comes down to the vertically integrated ecosystem that Apple caters to. But if you actually look at in the last year or last quarter with sales down about 1%, they actually demonstrated about 8.2% growth when it comes down to services. So I think what's happened in the last year is the elements of their hardware sales have actually been weak, but services sales are actually pretty strong at 8.2%. Now, looking at the stock since around the beginning of the month, the stock is down about 10%, hitting around the $196 area. And some would say, based upon the report, in terms of weakness when it comes down to hardware sales, particularly iPhones and iPads, which were down close to 20% year over year, no one's really looking at the expansion of services as really a growth catalyst. What I actually see here for Apple is, yeah, we're seeing essentially what one would consider, based on a trailing basis, kind of a high multiple, around 30 times earnings compared to 25 times earnings on a 5-year average. But if you actually look at the breakdown of net income margin and gross margins are actually higher by about 3% year over year, or 300 basis points, and so is net income margin. So I think the situation for Apple is, yeah, maybe the stock got a little ahead of itself as we got a huge boost, particularly in May, I think with the artificial intelligence ramp up that NVIDIA provided the rest of the marketplace, especially the technology space. But maybe some of the elements of that high multiple are starting to compress. If you look at right now, it's trading around 27 times forward earnings at around $6.56. And one would say, look, if you want to say Apple is worth its historical multiple of 5 times, 25 times earnings, then maybe 160 or so area is a place that buyers will step in, at least the institutions who are looking at valuation.
George, I understand the valuation argument, right? And everyone, the valuation argument is something running through a lot of stocks, frankly, that we watch on a daily basis. But in terms of Apple, I thought it was very interesting that currency headwinds were a big reason why their numbers, their revenues was down. They fell 1% to $81.8 billion. But that was better than expected. And if you take out the currency headwinds, revenues were actually up 3%. So this is a company that continues to perform, but no one can argue with evaluation, right? When you get so much stretched from your norm or your average valuation of 25 times earnings, it's not surprising. But George, Apple's almost oversold here on the downside from the recent highs. So the question is, George, is this getting overdone, or should traders, investors really be paying attention and watching that valuation, because it's still stretched, George?
So that's the thing. I'm going to look at it from a valuation standpoint, because Apple's growth, at least in the last year, is decelerated, and that's really based upon the hardware cycle. I think people are delaying purchasing new hardware because of inflation and maybe some of the elements of household budgets being stretched. But if you look at not the growth rate, but the profitability profile, profitability across gross and net income is higher year over year. And that's impressive. And both those numbers are higher than their 5-year averages. So looking at it, Kevin, if you want to say Apple's worth 25 times earnings, then about $164 puts you there at $6.56 a share in terms of forward earnings based upon today's estimates. If you say you want to add a 25% margin of safety, let's say at 20 times earnings, then you're somewhere in the 130 area. So my point is that somewhere between 130, let's say, and 160, institutions may look at that as very cheap, considering. So is it cheap right now? Yeah, it's getting cheap. Could it get cheaper? It certainly can, but that's contingent upon that multiple compressing all the way down to 20 times forward earnings, which again is going to be about 5 points below its 5-year average. So I think it looks interesting. Let's just put it that way right now. Buyers are starting to potentially step into Apple here. It's giving you back about $18 off the most recent highs, but it certainly can get a little bit weaker from here because of the fact that I think that we're still in sort of a short-term mild correction, let's say, especially in the technology sector. I know today the markets are higher, but just look at the trends in the last couple of weeks, and you can see that overall 2-week softness, especially in the tech names.
All right, great stuff. Great breakdown here of Apple for us. That's George Tillis, Senior Markets Correspondent. Kev, so let's get to an example trade in here. So I looked at this one. Late September, they typically have, or historically have had, that new product announcement. We expect the same this year. The iPhone 15 announcement, maybe a new watch, maybe some other products, maybe some more clarity around that that thing you wear on your head to play video games that they're touting for $3,500. Who knows if that'll sell? But I looked at a strategy to take advantage of that. You mentioned the stock pulling back pretty significantly. We're sitting right at its 100-day moving average, bouncing off of it today. Maybe that becomes an area of support. So I looked at something in the strategies where if you think it's going to reverse, maybe you think it's going to go higher, you don't want to buy the shares. I looked at an in-the-money call vertical here where you're buying a call in the October cycle, so it's 67 days till expiration. You buy the 175 strike call, it's about $4 in the money. And then against it, you sell the 190 strike call to offset some of the costs on that bullish call that you bought. You're paying roughly about a $7.50 debit for that. There's going to be your risk, $750 per spread on a $15 wide call vertical. Kevin, the risk reward's 1-to-1 on this one. The debit that you pay is your risk on that $750 per spread. But that break even, it's less than 2% above the current share price at 182.50 is your break even where you're profitable above there. And to get to 190, Kevin, that's still over 6% from this area. When you look at this type of strategy, give me your take here on this one.
Yeah, this is one that doesn't play the Vega or the Theta game so much. You're all in one expiration. You're all the way out till October, like we already mentioned in the other spread, 67 days for this to happen. So if you think Apple could recover just half of what it's given up over the last couple days here, Tom, this is one that doesn't take you to a new all-time high. It just needs to get back to the 190 level. And so this spread would max out. You'd basically take a $7.50 investment, turn it into $15, Tom. So one one fundamental way to look at a bullish spread in Apple, giving you about 36 deltas. Very similar, Tom, to the diagonal that we put on holdings, but this is different, right? You're buying it in the money and you're selling it out of the money to a diagonal, but this is different because they're both in the same expiration time. You're buying October, selling October.
Yeah, and you don't need that massive move back to all-time highs just below 200 to be profitable on this. You need, for max gain, you only need about a 6.2% move to the upside to that 190 strike over the next 2 months or so. So good look at a directional heavy delta call vertical to the upside. All right, that's going to do it for Kevin and I today here on Fast Market. But stick around right here on the TD Ameritrade Network. Next Gen Investing is coming up with Alex Coffey and Jenny Horn hosting. Have a great day.
Mm-hmm. Average is still down 11%. GME climbed up quite a bit, only down 1.5. RAD did flush there. Retesting that 27-day looks like. Bouncing back up to VWAP. It was barcoding earlier. Got MNK up. MNK's up 14%. Megal's up 11. Almost 1 o'clock. How are we doing? 22 likes on the day. Pretty slow for a Happy Money Monday. Market's pretty slow. It's pretty. This morning was quite choppy and bazzy. But now I've been trading in a range for 3 hours. Well, 2 hours actually. Economic data tomorrow. We have retail sales in the morning at 8:30. Import price index as well at 8:30. Business inventories at 10, and then Kashkari speaks at 11.
as well, Jenny, as you know, with ties to AI, so that'll be fun. But as always, let's do upvote, downvote, not endorsements, not recommendations.
Not sure, Macaron.
Not any key themes.
One could also
here,
ask why I was up 10% on Friday.
But still, all on their own right, quite interesting.
Yeah, we are a little bit themeless to kick off the show, but we'll start off here with one of the stories of the day, and one story that or a stock that we frequently discuss on this show, that is, of course, all things AMC, which you would have thought this would be a good news, because a lot of these AMC enthusiasts have been pushing for this story, or this move, for quite some time, but we are not seeing that today in the shares. They're down 33%, trading at $3.52 a share. So AMC did win this court approval of the stock conversion plan that had launched this shareholder suit and had cast a cloud over the company's efforts to secure some new financing. We saw Ape shares actually soar on the news, but typically these names have seen the opposite directions on this settlement case. Now, in early April, AMC did propose a settlement with shareholders to allow for the conversion of Ape units into common shares. The proposed plan does also include a 1-for-10 stock split, but the court had initially rejected the settlement at the end of July. AMC then sent a revised settlement, and then last Friday, the court did approve the revised stock conversion plan. The settlement could reportedly be valued up to $120 million. And although a timeline has not yet been provided, AMC representatives did indicate that the new financing could come as soon as next month. Now, in a letter to shareholders, CEO Adam Aron did say that this was the right path for AMC, saying they can use this to access equity capital to shore up their cash reserves, pay down their debt, invest in growth initiatives to strengthen their operating profitability, and pursue this transformative merger and acquisition opportunities in the long term. Now, this settlement that was approved does include some extra shares for individual investors, thousands of whom had actually opposed it, given the fact that it would be the dilution of shares, which I'm sure is why we're seeing this massive sell-off today. But this story, Alex, it just is an ongoing, a novel of all things, the drama with AMC, but it's not exactly where you want to be with your shares. It's now at $3.50.
Yeah, I mean, the company is obviously struggling. That's why it's got to do some of this. That's why it's done some of these equity issuings in the past. We know it was extremely disrupted during the pandemic, but it has a trading interest for different reasons, of course, with sort of its meme stock, tendencies that it's had with many of those big moves being driven by short selling and the covering of those short sellers once the move began. You know what I'm looking forward with this, Jenny, is just a little bit of finality with some of this litigation around this. Let's get this done, and then maybe watch this stock move around for other reasons. I think it's a good call out. I'm glad we had a chance to talk about this, but we'll see where it ends up, and look forward to discussing it in the future once some of this drama is in the rearview mirror. Next one on the list, though, moving for different reasons. This is a name that reported earnings in the last few weeks. Airbnb, it's a company that we all know well, especially those who have traveled in the last few years. It's a real competitor now to traditional hotels, but different markets, different type of trips. I can go either way. I don't have a feeling one way or another in terms of Airbnb or the regular hotel, but not doing great today, down about 0.6%.
Right, and I feel like they serve different purposes, because I can understand staying at Airbnbs for different reasons than hotels, and I think we're seeing, the rising tide lift all boats. We do know it's been a very nice summer for these leisure stocks. Airbnb is up 55.5% almost on the year, but has seen this overall pullback that we have seen in some of these other travel-related stocks like airlines, cruise lines, hotels. It is down almost 13% now for the month of August, but we did see a Citi analyst today raising their price target on Airbnb to $160 a share from $135, also keeping a buy rating, saying they believe that Airbnb will continue to gain share in the lodging market, and they're impressed with the company reaching 7 million in active listings. What's also really interesting about Airbnb is they have some exposure to the housing market, given they've had this ongoing battle with now the state of New York regarding some of the policies. So there is that component that I would say is to be considered that's a little bit different than hotels. But we are seeing more first-time bookers use Airbnb, which this analyst said speaks to the growth of their overall platform. This name is skewed, I'd say, more neutral as far as the analyst coverage I was seeing. 42 analysts, 15 are buys, 22 holds, 2 underperforms, and 1 sell. The average price target does imply some modest upside. It's out around $142 a share. So $160 from Citi today, though, far more optimistic than obviously the median.
Yeah, Bernstein updating their note as well. They have outperformed in 168. Yeah, there's optimism here, and it had kind of an interesting reaction to earnings. Initially lower, then recovered. It's been sort of choppy ever since that report. So this is a name that has become as much of a conversation within kind of tech investing and other reasons in terms of sort of where it fits. And it makes it quite interesting. It obviously was super hyped when it first came public, and it hasn't, I would say, lived up to that hype entirely, but certainly tried to do its best so far this year. It's been a really impressive year, not only for, of course, Airbnb, but all those travel stocks, as you have said. You can see it alongside Expedia, as well as Booking there on the screen. Jenny, next one on the list, though, is DKS. That's Dick's Sporting Goods. This is one of the key players in this space from a kind of big box retail standpoint. A lot of its peers in the industry, except for the regional ones, have largely kind of faded away throughout the years. So one that we're expecting earnings on in the next couple weeks.
Yeah, Dick's Sporting Goods has quietly been an outperformer in its respective space. I mean, this name is clinging on to a 20% year-to-date rally, which in retail has been quite impressive. It has pulled back about 5% from its 52-week highs here, but it's been, I mean, a relatively strong uptrend for the last several years. They have had consistently really nice moves post-earnings, so we do have that earnings event next Tuesday before the market opens. But Bank of America today reiterating Dick's as a buy rating and raising its price target to $180 a share from $170, saying they are very bullish into their earnings event next week, also raising their second quarter earnings estimate about 1 cent ahead of consensus at around $3.83 per share. Now also expecting same-store sales growth of around 3%. Now, back in May, Dick's did previously reaffirm their full-year forecast, expecting their comparable store sales to be projected between flat and up about 2%. They are also guiding for revenue of around $3.2 billion, healthy growth on a year-over-year basis, and they did actually just previously announce last quarter this $1 per share quarterly dividend. So Dick's has been absolutely crushing it as far as performance and overall retail goes. We know we've seen some weakness as of late out of Under Armour and Nike, some of these names that obviously operate much more direct to consumer. But I think that Dick's Sporting Goods, I think you nailed it, has done a good job playing the field, and now there's sort of not really any major competitors left.
Yeah, it's sort of a, the strongest survive kind of a situation as we kind of get into this fall period. Football starts off. You got, fall baseball, schools kicking back off. So certainly a little bit of break, as Kevin was saying, right around here on the calendar, but a lot of those sports about to kick off. Maybe time to get some new gear at a place like Dick's Sporting Goods as well. Looking ahead to the earnings, it's going to be a margin story like so many of the others that we've looked at in the public markets, of course, over this last few quarters. Lower costs and sort of cost discipline, as well as higher sales expected to maybe actually see a little bit of margin expansion for Dick's Sporting Goods. So that'll be part of the story to watch. Next one here on the list, though, Jenny, is Meta. And, who could have seen this coming? I was told that Twitter, now known as X, and somewhere in the limbo between those two, let's just refer to it as Twitter for now, stood no chance. The big bad Meta was coming to town, and Threads was gonna shut that platform down for good.
I was approaching Threads sort of like the same way I approach every iPhone update. It's like I let everyone else update and work out the kinks, and I'll come a little bit late to the party. So it doesn't seem like, at least given the lack of hype we've seen around Threads, that I need to even download it at this point, because we are getting some really interesting numbers actually out of this data integration company, SimilarWeb, which did find that the average global time active users were engaging in Threads was only 14 minutes. This has decreased sizably from around 21 minutes notched back in July. Also, even more concerning than that, the highest point of Threads usage in the U.S. was recorded at around 2.3 million daily active users. And if you can recall, the headline was, this is the fastest growing consumer application in history. It had 1 million or hundreds of millions of users, beating OpenAI's ChatGPT. I mean, it was on an absolute rip. But since then, we've actually seen, just according to this specific report, that its users have dwindled to around 576,000. I mean, I think that when you look at social media trends, I think you have to consider it's more than just the first 2 weeks, right? We had names like Yik Yak, Daily Booth that also had really, really strong launches for the first couple of months and have since completely fallen off. So this is definitely concerning to a name like Meta Platforms. However, this name was on an absolute tear even prior to the introduction of Threads, which is why I always thought it was really important to separate the narrative, because they're doing well outside of Threads. This name is up 152% this year. It's up 240% off its 52-week low. And I would say they've been one of the winners of this past earnings season, continuing to just rip higher on the year of efficiency.
You know, the year of efficiency alongside just simply copying one of your rivals in your space when you're coming out with innovation, to me, those are just indications of maturation of an industry. You know, Meta has done a lot of things right. You know, Facebook, the key app that kind of kicked off everything that is Meta now, was revolutionary. It really, altered the trajectory of kind of how business and advertising is done. But Meta really hasn't come up with its own ideas in the last, I would say, decade. It's basically, bought Instagram, its most successful app. All the features on Instagram are ripped off of things like Snapchat and other apps. And so, Threads didn't really introduce anything new to the game. And so you talked about, Yik Yak. I remember that one. I think I was in college when it came out. At least it was different. It was a little bit, kind of a novelty, kind of like the Be Real of today is sort of hanging in there. They're sort of in their little niche. They have their time in the sun. But, Meta's got to come out with something new if they want to drive people to adopt a new platform. Just simply reskinning Twitter and calling it Threads isn't really going to get the job done unless people want to leave Twitter en masse. We just haven't seen that yet. But as we kind of think about narrowing these down, Jenny, I think the Meta story is a little bit detached from the Threads story. I think the AMC story, we've kind of covered that en masse, and that really only leaves us the other two.
Right, and we do still have Dick's Sporting Goods, which has yet to report. So we'll look at Airbnb as well as Dick's sort of a pre-earnings look as well as a post-earnings look at Airbnb. We will be diving more into those two upvotes, into the technicals as well as
sound guys just
trades. Stick around,
overzealous again.
We'll be right back.
Alright, SPY's close to the high of the day here again. See if we make a triple top or if we actually break out this time. 3 hours. Whap whap. It depends on what time frame you're looking to trade on. I mean, look at the longer time frames and work your way down to the shorter time frame, and looking for like a day trade. Yeah, if you're trading on the 1 minute, then just be prepared to get out that quickly, that short of time frame. You know what I mean? 15 minutes is kind of long for a day trade. I mean, you can use it. You can look at kind of the trend on the 15 minute, but then enter and exit on the shorter time frames, like the 5 or the 1. I usually leave mine on 5, but I'll cycle through 1 to see like a longer time frame to see what we're doing. I'll look at the 1 also for maybe just entry spots. Good thing. What's up, love? It's love. It's love. It's la 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 la. You know that Noah and the Whale song? Got some nice consolidation up here. Nicely done. Hey, Jay from the Bay. Afternoon. Ups a hand. Nice, well done. You took a vacation? Took a month off? 12 grand in IEP wins? Was that that vacation initiated because of the IEP gains? GME starting to fill this gap up here.
Going out to the September monthly is looking at buying a call vertical, also known as a debit spread, where we look to buy one option that is slightly in the money in order to sell an option just slightly out of the money, creating a risk profile that is somewhat one-to-one in risk to reward. If you're able to fill a $5 wide spread, in this case we went to the 130, selling the 135, you're able to fill a $5 wide spread for $250 or thereabouts. It would equal $250 in risk for every $250 potentially in reward. $132.50 would be the break even. Our other kind of loose guideline is to sort of try to have that break even near the current share price. Right now the stock is trading just over that mark, so that checks out as well.
You made money on
you
IEP
can see,
because
the risk profiles that
maybe that's the next trade again
that we are accustomed to seeing with these vertical spreads.
Good thing you took your
and
profits.
You can see pretty equal risk to reward,
Cut their divvy.
and also that break-even point pretty reflective of the current
Might be
share
another,
price as
might
well.
be another
So
dip buy though.
checking out kind of all of our loose guidelines here gives it a little bit of time to continue this upside move if it's going to continue. Stock's a little bit weaker today, Jenny, so despite some of the optimistic analyst chatter, a little bit of a dip here. This could be a strategy for those who are looking to buy that dip.
And I'm doing it again. There you go.
Spread for risk definition.
That's awesome.
Okay, now to shift gears here and look at the name, obviously, pre-earnings exporting goods
Great.
does
Well, hope it's a good
report
time.
next Tuesday before the market opens. But this name is still holding out above its 250 simple day moving averages here. It is up over 20%, and it's down only about 5% from its all-time highs, Ben. So although the is less strong, at least this year, this name is,
Not sure if you're going to get the same kind of bounce you did before with it.
Yeah, and it's interesting, Jenny, that you mentioned that, because that all-time high really kind of sets this trend up for what's going on here at the moment. Because, as you mentioned, that long-term uptrend still very much intact, but it is consolidating into what we would refer to as maybe a long symmetrical triangle, with the apex in this case right around that 140 mark, which coincidentally on Friday is where the price of the stock moved down to. Today we get a little bit of a gap up and rally bouncing off of that 140 mark. That being said, though, these are still successively over the last 3 earnings announcements. Realistically, we've had 3 successive lower highs. We've also had higher lows, so that's what gives us that triangle formation. So the potential here is for that bounce and gap up rally to continue. If it does continue, you've got a breakout perhaps up to that 148, maybe 148.5 diagonal resistance. On the other hand, if it breaks this 140 support, which is sitting kind of right there at the middle of the triangle, that apex still may be a couple of weeks away at least, potentially just from the length of time that it's taken to form this pattern. It could break down below that support down to the 30-period simple moving average around the 137 mark, possibly even as far as that diagonal down around at the 135. Because what's starting to happen here, despite the strength of the higher lows, those lows are getting a little bit higher as well. The RSI diverging slightly bearishly as price moves higher within the context of this pattern. So that slight bearish divergence could drag this price back down towards that lower diagonal trend line, Jenny.
Right, I think that's a really good point. Also, looking at this name from like an analyst perspective, it's a little bit more mixed here. I think just given some of the fact that we've been sort of stuck, like you pointed out, in that all-time high key area to watch. I had to triple check to make sure it wasn't just a 52-week high, but even more impressive, of course, that we're right around that all-time high. But we will leave it there. Appreciate the technical breakdown. Our chart master today, Ben Watson. So now looking at an example trade in this name here, Alex, looking to lean into a more neutral to bullish stance here. Of course, we do have earnings to consider next week.
Yeah, exactly right. And what we did here is a little bit more complex, contains a little bit more moving parts than the one that we looked at in Airbnb. It's referred to as a skewed put butterfly. Essentially, it takes both a debit spread and a credit spread and kind of overlays them on top of one another, converging at the same short strike. The reason we refer to it as skewed in this case is because we're looking at actually selling a $10 wide spread in this example, while only buying a $3 wide spread. That's going to allow us to do this whole package for a credit, even though there is some portions of this in which we're buying premium. We're going out to the August 25th cycle. That's not this Friday, but it's the following cycle. It's going to be the week of earnings for Dick's Sporting Goods. So it's going to be sort of the peak of implied volatility. If you kind of imagined implied volatility kind of like a mountain. There's a very steep ascent right now in this week from this week to the next, as next week is when that event would be. But then as time goes out further, that event's going to have a lesser and lesser impact, so implied volatility starts going down with that. What we're looking at here is the risk profile of the exact trade. In particular, we're looking at that August 25th, 138, 135, 125 put butterfly spread done for a 50-cent credit. In the event that this stock stays above 138 and all of these options were to expire worthless at expiration, the trader or investor deploying this type of a strategy would just hope to keep that credit that they received when entering the trade. In this case, that's 50 cents, so $50 would be the max profit. Going to perform like a short credit spread in that case. You can see that there's that added sort of kicker, though, right around our short strike of 135. That's if this is, right at that 135 mark, also kind of converging to that upward slanting trend line on that pattern that Ben had highlighted when he did his technical. So kind of method to the madness here in terms of strike selection. But the reason you see that upwards tick in this particular performance is that's the point at which the debit spread as well as the credit spread both would be working for you. Once we get beyond that 135 mark, it is dollar for dollar risk down to the break even and beyond until we get to that 125 mark, in which the risk caps out at $650. So you find that by taking that 50 cents, taking that $3 debit spread, you add that together, that's $3.50, subtract that from the $10 wide credit spread, and you're left with $650, or of course, as we know in dollar figures, that's $650 in risk. Break even is $131.50, so a good, nearly $14 below the current share price, giving us quite a bit of room of nearly 10% below the current share price here going into earnings.
Right now, I'm relieved to see no October or September expirations here. We're keeping it near term and an earnings pure play, of course. We will leave it there, though. Also important to keep in mind for both of our example trades today, they do contain multiple legs that can lead to higher transaction fees. Short options can be assigned at any time, and carrying option positions into expiration can add risk, like unanticipated exercise or assignment. Now, coming up next, it's time for FOMO. We are looking at all things NVIDIA, which is making quite a nice move higher on the session. It's up almost 6.5% now after a Morgan Stanley
GNS coming down there, broke VWAP. Still up 24%. I don't know, Sahin. It's as dire as ever for that. I think for anything with barbecue. It's still a possibility because it's still trading basically. You won't know that it's not a possibility until it's too late.
To say this is like the barometer of the AI trade because it's been such a stronger performer than everything else. I mean, shares are up almost 200% this year.
That's how I see it, at least.
Even with the recent cooling
and most people
in shares, I mean, it's down 7% for August.
Have sanity,
so
think it's not a possibility right now. So
pullback by any means. Pretty much every name we've discussed
it's a possibility
has seen actually almost double that degree of pullback so far this month. We're up almost 300% off of our 52-week lows. So only continuing to see more bullish activity today after a Morgan Stanley analyst did confirm this is his top pick among companies that are expected to benefit from AI, and that this recent sell-off makes for a good buying opportunity. Now, this analyst does have an overweight rating on NVIDIA shares with a $500 price target, saying the stock remains his favorite play into their earnings, which are Wednesday, August 23rd after the closing bell. He does still expect a meaningful beat and raise quarter, and more importantly, some strong visibility over the next 3 to 4 quarters. He also expects a fairly exceptional supply demand imbalance that should persist for the next several quarters, saying nothing now is unusual about how this situation is. He did note that NVIDIA's revenue forecast last earnings report was the largest single increase on one quarter in the semiconductor history, and then outlook with some potential for upside in his view. So he actually even thinks that with last quarter's really optimistic guidance, he sees even more room for upside. We did see last quarter that NVIDIA forecasted their second quarter revenue to be around $10.8 billion was from $10.8 billion to $11.2 billion, which would vastly exceed the company's previously quarter record of around $8.2 billion. So some of these estimates, when you look at their growth metrics, it's absolutely phenomenal. Analysts on average had forecasted around $7.2 billion for their previous quarter, and they absolutely blew past that, now expecting at around $11.1 billion as far as consensus. So, as some critics though have pointed out when looking at this name, billions of dollars right now are being thrown around in some of these AI plays. These are all still estimates or projections, because obviously this is still a fairly developing market. So there are then some critics of names like NVIDIA or AMD that have run up this year. NVIDIA. There are still a lot of costs and infrastructure and different various steps that have to be taken before we can necessarily say this is a pure AI play. Obviously, NVIDIA has several other revenue streams that have been a little bit lackluster over the last several years. Their gaming being one of them. But I mean, it's difficult to even discuss that when you look at a name that's up almost 200% this year, the best performer in the S&P 500. We did actually get some interesting reports that actually Amazon is throwing its name into the ring here, designing custom microchips for their AWS's AI training and acceleration that will then bypass NVIDIA's GPUs for the large language model trading. But NVIDIA shares, completely brushing this off today. Analysts love this name. Of the 51 analysts covering this, we have 44 buys, 6 holds, 1 underperform, and the average price target at around 501 is right on par with this Morgan Stanley analyst. But I was actually curious, the highest price target I could see is $767 a share, which is so far above where we're currently trading.
I don't think I've heard one person on this channel say it right.
Year, I can't necessarily discount that.
Taking crazy pills.
Yeah, I'm seeing $1,000 price
crazy pills
from Alethea Capital. So I'm not familiar
I'm
with
starting to question if I'm saying it wrong.
With that outfit, but there's some positive ones. You dig deep. A lot of analysts are covering this particular stock. The average price target, at least according to Bloomberg, is close to $500. So goes to show you that there's certainly optimism when it comes to NVIDIA, and I think rightly so. Regardless of
you'll
AI
hear it now.
ends up
If
being
you weren't already aware,
something that
now you'll hear
drives
every person
costs
say it
lower,
wrong.
revenue higher for companies outside of NVIDIA,
just,
it
can't
is
undo
certainly driving customers to NVIDIA, and they're selling tons of these chips. Revenue is expected, if it comes in around that 11.04 billion as it's expected right now, is about 65% growth year over year, but they're doing so efficiently. The earnings, if it were to come in at the 207 estimate, that would be nearly a 300%, actually more than 300% increase year over year in earnings. So this is the company that, regardless of how you feel about AI, where it is, where it's going, its true impact, it is impacting NVIDIA, Jenny. There's no doubt about it.
Yeah, it is definitely impacting NVIDIA, so I think it's one of those things we can
I'm
sort
sorry,
of speculate on the evaluation.
I've mentioned it before. I've tried not to mention it too much.
Betting on the fact that generative AI could be worth tenfold what we're seeing right now, and it could be expanding its push
every single
into
person,
various
that's what they
markets.
say.
And again, that takes infrastructure, that takes money, that weighs on a lot of these companies that have to then unveil different costs. We've seen that it's not going to be a seamless transition. We're not just going to be automatically in this AI world, right? But right now, I think you have to take NVIDIA for what it is. But now the concern is, are we just priced too perfectly into this earnings event? And I said this exact same thing last quarter, and I was dead wrong. So I do think that right now, for all the skeptics, because we'd seen a nice run into their previous quarterly print, that could we see history repeat itself here?
Well, the only thing that I think is very different about this quarter from the last one is they really don't have that ace up the sleeve of resetting expectations. They've already done that. They've already kind of brought the optimistic message. They've already kind of told you, how much they can ratchet up revenue. It'd be very difficult to do it to that extent once again. All that being said, though, from a valuation standpoint, this is a name that's only at the moment, at its current valuation on a forward PE metric, is only about 13% premium over its 5-year average. Right now it's trading about a 45 forward PE. Historically, it runs around a 39, 40 on that particular metric. So it's really
GME filling the gap a little bit, new high of the day.
Expensive from a valuation standpoint versus history. But they did, of course, really ratchet up those kind of expectations going forward for driving these valuations through that just really incredible guidance hike that we got last quarter. Not sure they're able to do that again, but I will certainly eat crow if I'm proved wrong. Jenny, from a trading standpoint, though, we talked about that average price target, consensus price target for a 12-month time horizon, according to Bloomberg, being around 500. I did a strategy that would benefit from that taking place a lot sooner. I looked at a $500 call calendar that just goes out not this Friday, but selling the Friday following, which is the earnings week, and then buying the Labor Day or the weekend of Labor Day expiration September 1st. Buying that 500 calls. So selling next Friday's, buying September 1st, 500 call calendar, $1.75 debit would be $175 in terms of premium. Any way you slice this one, it's going to be expensive. There's a ton of implied volatility in this name. The options are quite expensive. The stock price, from just a per share standpoint, not a valuation reference here, is quite expensive now, over $400 a share, and actually up to $434 already today as this stock is
I don't think there's any news on barbecue.
On the session.
No, just giving back its gains from Friday.
It has a wider net than that $500 call calendar would suggest. If you got a pretty substantial upwards move, either into earnings or post earnings, it is certainly possible that this spread would widen,
this resistance today.
And an opportunity for a trader to consider closing that if the secondary markets allowed for that for a profit could persist. But of course, there's risk to the downside, and there certainly is risk to overshoot this to the upside. But I mean, we'd be talking historic moves back-to-back quarters if that were to happen. But again, anything is possible. $175 in risk to participate in something that is trading for per share $435.
Yeah, it would be amazing to see if they could repeat the previous quarter because it was a phenomenal move to the upside. I think right now the skepticism is, can you make that same magic happen twice? But I mean, obviously crazier things have happened. So we'll obviously be keeping NVIDIA on our radar as this name has been able to generate headlines almost every single day, it feels like at this point, but we will leave it there for FOMO. Now, coming up next, we will look at another name that is making a nice move to the upside today. That is all things Monster Beverage, as it does aim to be the dominant player in the energy drink market. At least that's what HSBC says today. Shares are up about 1%. We'll discuss that story more coming up next.
We're stuck in that channel. It's like spy. NVIDIA is up a lot, 6.5. Big bounce. Big bounce. Little head and shoulders up here on the 5-minute. And what appears to be a triple top. We also could be having a little cup handle out to the upside as well. Bounce there on GNS. New ones I'm showing on the screen. I don't give recommendations. Kind of make observations. Then I tell what I'm doing. I don't know, yeah. I like GNS to the long side, but it's had a big move if you're not already pretty profitable on it. It's not great. I like RAD still. This might be a good dip buy, or the whole move has been done already. I don't think it's over yet. Spies down here. Still like Dish to the long also. Same with Tupperware. Tupperware did bounce off that 50%, so might be a nice entry. Pretty sketchy ones though. All of those mentioned.
Squarely in the crosshairs as well. Really a company that seems to have expanded the addressable market quite a bit in terms of kind of reframing this conversation. I know that Monster's far more mature than the company that was just sponsoring motocross drivers and X Games athletes, but Celsius has really kind of reframed the conversation to something about fitness, and something that I think a little bit that casts a little bit wider net is this is just truly another alternative way to consume caffeine or something in the morning to get your day started. I say it every time. I think I'm contractually obligated with my last name being Coffee to be a coffee drinker here, Kevin. But I respect this space, and you can't do anything but respect Monster's performance. This has been a powerhouse of a stock throughout the years, continues to be just that. But is this not, now you can agree or disagree, feel free. I guess the ultimate question is this not just a situation where the rising tide is lifting all of these boats, be it Red Bull, be it Monster, be it Celsius, as this is just an industry that seemingly is growing very, very quickly?
It is. I mean, there is a lot of competition. I think right now the winners in this space are the ones that can market really well. So at the end of the day, yes, it's going to be about the product offering in itself. Does it taste good? Does it not taste good? But are you also marketing to a segment of the population that obviously drinks these energy drinks and health drinks right now, or could be influenced to do so in the future? And I think that's really what Celsius has done, especially when we looked at their previous earnings announcement. I mean, they knocked it out of the park as far as their growth rates. Now, Monster and Red Bull, they're definitely a lot lot more mature markets and companies here, but they still have some areas to grow, especially in the emerging markets, which is something that has not really been explored as well as what we've seen here in the United States or in North America alone. And I think also a little bit of that is obviously transportation costs, shipping costs, which eats into margin. So some of these areas you have to be able to scale up fairly well in order to turn a profit, and that's probably why we haven't seen that much investment in some of these emerging markets.
Yeah, and Kevin, to your point, Celsius has done such a great job outsourcing a lot of their network to PepsiCo, who then bears the brunt of the supply chain costs, whereas Monster has mentioned that on their last several earnings call. Aluminum also continues to weigh on them overall, but still, overall positive day for the stock and positive note out of this analyst. Appreciate the coverage on that name. Kevin Green, senior markets correspondent for the network. Now, coming up next, it's time for Under 30. We are looking at Hawaiian Electric with a pretty sizable move to the downside today. Shares are down almost 38% amid sub-turbulence with the wildfires that are ongoing right now in Maui. George Tellis will have more on this story for us coming up next.
You're cutting them off with the music, man. Every time. Crazy. Yeah, that's kind of what we're looking at a little bit. Maybe a triple top up there. Gotta keep careful though, because it could just be in a bull flag, longer time frame, and longer time frame starting to flatten out on this cup, or at least on a way up to retest this channel to the downside, distance on it. The macro still has some bullish looking stuff the way we bounced off the lows. But intraday, yeah, could be a triple top on there, even a head and shoulders. Liquor back to its lows. Thing is just pumping and dumping. At GNS, up 25%. Barbecue down 10. That's supposed to be Guten Morgen. Go ahead, dear Morgan. Love psych you up. Where are you? It's morning. Only got 2 hours left in the market. Spilled some of my coffee. Worst part is not the mess to clean up on myself and the floor, but it's that I have a little bit less coffee.
Issues as well, that analysts had weighed in saying that this deal might be unreasonable to even think it would go through based on regulation. So
right.
We'll have to see on that
huge.
front too.
It's huge. Let's get to NVIDIA, reiteration of some positive comments there.
Everyone.
Yeah, so NVIDIA reports earnings next Wednesday, August 23rd, and ahead of those earnings, Morgan Stanley named it a top pick, saying that the recent sell-off is a good entry point. Now, obviously, NVIDIA has been surging higher for most of the year, but it's up about 5% today. I was just taking a look, off about actually 6% right now. But still off about 8% so far in August alone. And Morgan Stanley says despite supply constraints, it will have a meaningful beat in Ray's quarter. The analyst there sees durable, steady growth given that overall industry conditions are oversupplied, expects a very positive outlook for the October quarter, and as such says that now is the time to buy. Also says the implied $7.5 billion in quarterly data center revenue is trending to $15 billion plus over the next few quarters. So the analyst made no change to his overweight rating and $500 price target, but that implies about 15% upside from current levels. And given the fact that NVIDIA has already run almost 200% year to date, that's pretty significant. I will say, though, $500 price target, not the highest on the street. I was taking a look. Rosenblatt, HSBC, and Barclays are at 600. Heading into earnings, Susquehanna's at 575, B of A's at 550, Citi's at 520. So really bullish price targets on the street, and we've only been seeing those, really tick higher. Just in terms of the earnings, NVIDIA's expected earnings to rise, or the earnings are expected to rise to $2.06 per share on revenue of $11.02 billion. If you take a look at that number at the same time last year, $6.7 billion in revenue. So really a huge run up. And this analyst thinks that it'll be a beat and raise.
Yeah, I mean, look, it's been a clear outperformance, and it had been up over 200% when it hit that high of 480. I'm sorry, 480. Yes, that's right. And so we'll see what happens here. But I wonder if it'll turn the tides, too, because we've seen tech and S&P selling off the last couple of weeks. See if they could turn it around. Because month to date, it's down 7%. You know what I mean? But a great day today. Thank you for both of those stories. Caroline Woods. Good to see you, Caroline. Thank you. Okay, up next, let's take a look at the bigger picture. Alexander Reed's with us, CFA Chief Investment Officer at Envisage Wealth. Thank you for being here, Alexander. Your thoughts on what's going on? What do you think the Fed may do?
Sure. Thanks for having me. So looking at the Fed first, kind of looking globally, continuing to be underweight international emerging markets. You know, we're starting to see a continuation of further deterioration in the Eurozone, composite PMIs, disappointing China data. But really over the last 3 months domestically, you know, May, June, and July, we're kind of seeing a mini reacceleration in manufacturing and durable goods orders, whether it be soft survey data or the hard economic data. And I think that's going to cause kind of a concern from the Fed's perspective, right? So we've seen inflation come down, but over the last 3 months, energy, a lot of the commodity prices with crude being up 18%, and the energy stocks being the big contributor to, from a sector leadership perspective, we're kind of in an odd spot from the Fed's perspective of saying gravity, the economic gravity of the cycle continues to pull down the economy, but we're kind of seeing this mini reacceleration on the manufacturing side, and that's pushed up prices on the commodities, which may throw a wrench into the Fed's perspective of cooling off or pausing for this next rate hike. Now, as we said here today, you know, the market's essentially a 90% chance that the Fed's going to pause in September. So we'll get one more inflation data point before then, another jobs report. We continue to think that it's not as easy as an answer as I think the market's anticipating, because we're kind of seeing this reacceleration in macro data, but the expectation is that there's a soft landing, no interest rate cuts, rises for the rest of this year. So that's really kind of the interesting catch-22 from the market's perspective right now is, you know, there's no interest rate hikes priced for the rest of this year. And then you look at 2024, the market's pricing in almost 100 basis points of rate cuts. And you compare that to 11% earnings growth. It's really hard for us to think about what type of economic market and economy would support 4 rate cuts, but also deliver 11% earnings growth. So that'll be interesting, and that will kind of come to fruition and find out which is right, the bond market or equity analysts over the next 3 to 4 months. That's our perspective.
Yeah, I know you were looking at durable goods, for example. That was something. Energy has been running up to some recent new highs.
Lark?
I mean, what are some of those
you're in the lounge?
themes telling you?
You want to come in the stream?
No, really seeing kind of this stagflation type of environment where growth continues to slow down. Now you look at the nowcast from the Fed, you know, it's around 4%, but it's early on in the quarter here. So it's kind of this slowing as we think about kind of the broader business cycle. The Fed's still restrictive policy, whether there's another rate hike this year or not, it's still
Bullion
restrictive.
says
The business
barbecue
cycle is kind of pulling
16th.
down that natural gravity, but we're seeing kind of this mini inflection in inflation. You know, the year-over-year comps from CPI perspective were easy in June, and they start to get harder as we move through the rest of this year. So, you know, when you have those harder comps combined in the face with accelerating commodity prices, that's not a great recipe from what the Fed wants to see to be on a pause.
VWAP here, flush us through what we got.
You know, for us, we still think the recessionary probabilities are elevated, but it's been really pushed out from, you know, an immediate turn to kind of intermediate, you know, into next year if a recession does occur.
You'll only get respect for Yaz.
That is and could continue to occur, which I believe you think it will, provide opportunities for investors, and if so, how would you describe what they should do?
Sure. Yeah, so we're telling clients on our side, we've had a great start to the year. We looked at the top 15 starts, the best starts to a calendar year going back to 1930. And what we've seen so far this year, was ranked 13th. So the 13th strongest start to the year since 1930. And the next question is, in a lot of our clients' minds is, if we have such a strong start to the year, what can we expect for the second half?
I'm gonna stop and break even on these
most
things.
People's thought is that it can't repeat, and most of the time it does not. So when we look at the strongest starts to a calendar year, the back half of the year tends to average around 3%. So that's helpful in terms of kind of calibrating your expectations and not extrapolating the strong returns we had this year. Combined with a lot of the different macro factors in play, for us, it's a clear recommendation to kind of harvest gains, a lot in the mega cap tech area, and reposition that into quality growth, whether that's in healthcare, staples, communication services, and kind of expand out with the expectation that gains for the rest of this year should be positive, but it's going to be a little bit harder treading than it was in the first half.
Communication services. Now, some of the communication services have really run up, right? What parts of that are you looking at, or just a whole group like an ETF?
Yeah, really kind of the whole group of the ETF is one way to play it. We like to be more selective. So there's a few, the communication services itself is not a large grouping of stocks, but when you compare earnings growth relative to, PE ratios, I can't speak to individual stocks, but there's 2 or 3 out there, the communication services that
GNS popping back up to VWAP there.
One of the other 3 in that is probably not.
Nice.
Understood. And
taking some profits on that move.
You mentioned healthcare
Didn't even get to
staples as areas you do like. What about
215. It's late enough in the day. Market can make its move.
Also pays a dividend.
Or it can just chop.
Yeah. So energy, from our perspective, is really kind of a tactical play. We still think the probability of a recession is elevated and not gone. But at the same time, you can have, as it does in many late cycle environments, you can have these contradictory signals pop up. Energy, what we're seeing right now, I think, is one of them, where it's kind of re-accelerating as a strong tactical play. You look at price momentum, you look at all the different leaderships in different parts of the energy subsector, and that could be an attractive tactical play, 1 to 2 months. But outside of that, we still think the business cycle slowing is more beneficial to healthcare staples, high quality growth. But we think that could be a attractive tactical play over the next month or 2.
Right, understood. Great to see you. Thank you so much. Alexander Reed, CFA, Chief Investment Officer in Visage Wealth. Thank you. All right, later this hour, we're putting retail earnings in focus out of those reports that we're waiting on from some of those big box names, right? Home Depot and also Target and Walmart this week. Also, we'll take a closer look at a new CEO. What does it mean for PayPal in the payment market segment? And our panel ready to focus on Bitcoin, crypto, blockchain. And up next, why you might want to take a closer look at some big names such as Pfizer, Comcast, and Verizon. David Dietz will explain next.
David Dietz? Mr. Dietz is his name? That is neat. Give me that little giggle. Michael Burry has bought puts worth $1.6 billion. $740 million against NASDAQ, $900 million against the S&P. This is the way. I actually thought about getting some SPX puts as a hedge today. I actually put an order for them. Oh, it'll probably won't fill today. That's a pretty large amount. You did $1.6 billion worth. I'll adjust my order. I still see us maybe making a double top here, but on the longer time frame. No signs of it yet, though. Not specifically. GNS breaking VWAP. The upside. Okay. I put orders out on E-Trade and they just go pending, which a refresh. That seemed right. Buys almost a VWAP. Will we make an inverse cup on the day? Might not finish it today. Maybe tomorrow. Or are we just in this bull flag still? Close a couple puts there. Like to just see a flush here. I close some, it entices it to flush. You gotta coax it a little bit.
We'll be talking more about Bitcoin and crypto later in the show. All right, let's get some more names and trends that you should have on your radar. Joining me right here on set, David Dietz, Managing Principal and Senior Portfolio Strategist with PPAC Private Wealth Management. Thank you for being here. I'm glad you're here. So, I mean, I think our first topic should be Fed. You don't see really a Fed rate hike so fast in September, right?
Yeah, right now, Fed fund futures are telling us there's only an 11% chance. We are seeing inflation come down. We're about
is that your only one so far?
That's still above their target.
I think I asked that question before. I can't remember.
It was a slightly hotter than expected producer price numbers, but on balance, we're trending in the right direction.
See?
Having said
Told
that,
you only get respect for the
traders
ass.
are also forecasting a 32% chance of a hike in November. So maybe the Fed is setting ourselves up for an every other month hike. Having said that, we're somewhat bullish here because we think we're in the 8th or 9th inning of these.
Never heard that.
The inflation is starting to dissipate. At
Must
certain
be a
point, if inflation keeps coming down, they're
right.
going to have to start sometime next year thinking about backing out some of those hikes.
Yeah, and you said Goldman Sachs was talking a little bit about that, right?
Absolutely. So you can talk about keeping interest rates constant, but if inflation starts coming down and continues to come down, the real interest rate starts to go up. And that's not a good look for the economy, for jobs, and of course that all-important presidential election, November of next year.
Well, where do you think valuations are when you look at the market?
So, valuations are high. There's no question about it. We've had, the market up anywhere from 14% of the S&P 500 to close to 38% on the triple Qs. The problem is earnings haven't gone up at the same time.
Right.
All of that growth has been in terms of multiples. And so that could suggest that if earnings disappoint going forward or not, don't meet the lofty expectations that many believe will occur next year, then earnings come down, multiples shrink, that's not a recipe for a continuation of a raging bull market.
I want to get to your picks, but just a quick thought on fixed income.
Yeah, absolutely. You know, we kind of like fixed income more than stocks on a relative basis. I mean, we know that on the 6-month Treasury, you can get 5.5%.
Yeah.
You know, there's good reason for people to say, hey, let me lock down my profits in stocks, get that 5.5%, see how things shake out. Having said that, I tell people, if your horizon's 6 months, great. But if your horizon's 5 to 10 years, I still think stocks are going to do better. A 20 PE is still a 5% earnings yield, which is going to rise as has done historically over time.
Right.
And we all know that even the best of us, like your guests, rarely get that timing right to switch back into stocks after being in bonds a little bit.
Okay, so let's get back to equities. Goldilocks chasing the white swan. You have Pfizer, Comcast, and Verizon. Tell me the theme, and I guess start with that with Pfizer.
Absolutely. So Pfizer, that saved us, right? During COVID-19, they had the vaccine with BioNTech, and then they came up with Pavlaxid, the best therapeutic. If you, in fact, you got the COVID-19, it drove the stock up to 62 at the start of last year. The stock's now at 36. Why? Because we think COVID-19's in the rearview mirror, and people are saying, what's next? Well, a couple things. One is Pfizer is more than a one-trick pony. It has one of the best R&D pipelines in the world. More importantly, they have the best sales force in the world. They're not just U.S., they're also focused on overseas and emerging markets. So they have a long track record of coming up with good successor drugs. Second, of course, is maybe COVID-19 isn't quite in the rearview mirror. There's this ES5, which is starting to cause admissions at hospitals to trickle back up. And so you still may need this Pavlaxid to get you better. In fact, you get it. So they may also be able to package their COVID vaccine with flu vaccine, have a twofer that people will want. And so maybe people have oversold it. At the same time, you're buying Pfizer at just 11 times earnings when the market is knocking on 20. You've got a 4.5% dividend, which is triple the overall in the S&P 500. Right. This is a blue chip Dow stock.
Right. Sometimes people just don't want to know the obvious, right? I mean, it certainly seems like if you do it on paper, it does sort of say, you know, buy me, right? Tell me about Comcast.
Yeah, so Comcast is a little bit like a mini Disney, but has been very successful in staying out of the headlines. A and B, you still got that Roberts family, which, you know, in other words, that secure leadership, which is tripled.
You can DM me on Discord,
Turtle. Last decade, nearly doubled revenues over the last decade. So whether they're strength,
as far as I know, that's right. That was the answer.
In broadband internet,
as far as I know,
in the United
remember.
States. I mean, that's certainly your most secure service. We also like their business in terms of cable under pressure because of the streaming.
No one's away from their
just
keyboard.
What you want, wherever you want it, great. But they're also meeting that challenge with their Peacock service and so forth. And they're going to get a little lift because Disney, of course, is raising prices on Disney Plus. I think Netflix is going to be raising prices, also tightening up people who are sharing and so forth. So that's going to give a little bit more of a tailwind for their streaming business. And of course, I like their content, Nicole. You've got NBC, you've got USA Network. There's still lower budget things that people still enjoy watching.
They're trying to take away all my television shows on all the channels, and I don't like it one bit. And Verizon has been, you know, I want to quickly get a thought on J&J and what's going on with Kenvue, but, you know, these were some of your father's favorites, right? Names like Verizon.
Exactly, especially here in the Northeast. Everyone worked for the telephone company and so forth. My grandfather worked for Bell Labs. Thank God. But, you know, so Verizon, it just hasn't moved here. But you're rewarded if it just sits tight because you're at a 7.9% dividend.
We sold off quite a bit. It's only up 8% now.
In my view is Verizon versus AT&T. Verizon has less debt.
Verizon
has a better reputation for service.
Wait all day for this move to happen on SPY.
Is a better position to cut costs and pay back that debt. So between the two, I'd like
Verizon. Got one in the description. Got one pinned in chat.
Here, but you never know. There could be some M&A activities that ultimately shakes things up.
And look, AT&T has not been doing well at all. So, and then a quick thought on another one of our father's favorites, and that would be Johnson & Johnson. Are you a Johnson & Johnson fan? Particularly, I mean, now we have some big news. Kenvue was listed here at the New York Stock Exchange. Are you a Johnson & Johnson fan generally? And what do you think about what's going on here with the stock
J&J.
swap?
I mean, they're just in New Brunswick, New Jersey, my stomping grounds. I own shares, full disclosure. Most of our clients do. But right now, everyone is pulling their hair out as to whether they should accept this exchange offer. Basically, J&J has a consumer products division, think Listerine, Band-Aids, and talcum powder, and they're saying, okay, we're going to give you those shares in exchange for J&J shares. And a lot of people say, well, I think I'll sit tight and move on. They're saying we'll give you $107 worth of TenView for every $100 of J&J. There's the immediate sweetener. So the bottom line is there's a lot of caveats. It's a 400-page filing they called it was filed at the SEC. So there's
I don't use their Active Trader Pro, and I've had trouble with their
short-term,
just their website.
An opportunity to get more than you're giving up
by
swapping your J&J for TenView.
It's kind of buggy, actually,
term,
Fidelity.
J&J management is telling you they think that medical devices and healthcare will outperform in terms of growth than perhaps so-called stodgy consumer products, and I wouldn't bet against them. They're J&J.
Right, and so that's the whole thing. If you're a J&J fan, you could just stay with J&J. But the Kenview, they've sweetened that offer. So if people are interested in that, you could check it out and get some more information. You haven't made a recommendation on that. I'm just saying I thought it was an important point to bring up for folks to take a look. David Dietz, great to see you.
Thank you, Nicole.
Thank you very much for being here always. David Dietz, PPAC Private Wealth Management. All right, coming up, we're putting consumer trends in focus ahead of a big week for retail. All these earnings and retail sales, we'll talk about it next.
Getting out of these puts.
Services. Jerome Martis is with us, Director of Consumer Research, LSEG. All right, Jerome,
yeah, I use Webull, Fidelity, Thinkorswim,
I just mentioned
E-Trade.
one, right, of what the consumers are doing.
It's good to be here, Nicole. Yes, this week we kick off second quarter earnings for retailers. All eyes are on Walmart and Target. It's interesting because analysts pulled by LSEG are actually much bullish on Walmart. And this is because we're seeing a lot of the same theme that we saw during the first half of the year, which is that the consumer is still gravitating towards what they need. They still want groceries, and this is where Walmart has the upper hand. And as a result, analysts polled by LSEG have been raising those estimates for Walmart. Not only have they been raising them, but they believe that Walmart
is better poised, and it's likely to beat earnings estimates and post a positive surprise, whereas Target is still expected to struggle, and analysts are more bearish on the retailer because, as you know, Target is mostly known for its discretionary items, and as a result, the company has been struggling. Still, having said that, some of the other things for the earnings season is that the consumer is still very value oriented. Unless they feel like they're getting a good promotion or good discount, they're really not opening up their wallets. But when they do decide to splurge, they are gravitating towards services and restaurants, which is still
Thinkorswim.
Retail.
Oh, TD Ameritrade.
So what does this mean?
Yeah,
for
TD Ameritrade,
like
and then
very popular and
E-Trade.
pricey, like Lululemon
Fidelity and
Nike.
So there are some pockets of positive growth.
Are they talking about Target, or is this,
when they
is this Target something else?
Splurging at Walmart, they're going to the discounter. Athleisure is still very popular, and this is because of the strong demand in wellness. And in this category, Lululemon
all my homies call it Target.
In fact, Lululemon has the strongest same-store sale estimate for the second quarter at 11%. And this is on top of difficult comparisons from a year ago. So this underlines the strength at Lululemon. Other retailers that are expected to also do well are Ulta, with the reopening, and consumers still want to look good with their makeup.
Oh, that might be our move I was waiting for.
Because the high-end and middle-class consumers still want those high-end brands, but they don't want to pay full price for them, especially the American high-end luxury consumer. They're thinking twice before opening up their wallets, as opposed to the European and Asian consumer who are firing at all cylinders and spending more freely than the American high-end consumer.
Thank you for that. Just for a moment, to circle back from the names that are featured this week in earnings, and that's Home Depot, Target, and Walmart. With Walmart, a lot of people are excited the fact that they still have grocery, and that's doing very well for them overall. That's something people need. There was a lot of backlash for Target. They had some PR issues. Home Depot, I don't know how people are doing on the do-it-yourselfers and what they're doing with homes. Are any of these names likely to beat on the top and bottom lines? Which of these three?
For sure, Walmart. Walmart is the one that analysts are the most bullish on, and TJX.
Wow.
TJX also has a very
stop hunt right
healthy
there.
same-store sale at 4.5%. So those are the two names this week, at least, that are expected to surprise on the positive end. When it comes to Home Depot and Lowe's, they are facing difficult comparisons from a year ago and are still expected to see negative comps. But what's a positive this quarter is that at least those negative comps are an improvement of what we've seen during the first quarter. And that's what we'd like to see, that at least it's an improvement. Obviously, things have slowed down. They were pandemic darlings. And we expected the slowdown to happen this year. But it is an improvement from the first quarter. And that's the good news for the home improvement sector. But the winners are still Walmart and TJX this week.
What about Target?
Target is...
You said Target that time. They tried to mute her in case she was going to say Target and embarrass herself.
Secret ingredient that is helping Target is the fact that they have a collaboration with
turned it down real quick.
And this week's numbers are actually going to give us a little bit of a preview of what we can expect from the makeup company itself. But Target in itself has been struggling. Analysts polled by Alsa
I don't know if she said Target
have been lowering those estimates, and they believe that Target might actually miss earnings estimates. The company is not expected to improve until the fourth quarter of this year. That's when we expect Target to have a comeback during the holiday season.
Well, market's back to kind of its safety VWAP, and it still has an hour and a half left. So,
in fact, we're receiving more negative guidance this time around than we did for the first half of the year, of retailers warning us not to expect too much from them. Also because a lot of students will have to start paying off those loans. So on top of the consumer already being very picky because of high inflationary prices, they're also going to be facing to pay those debts off. So as a result, we could see the consumer pull back a little bit more during the third quarter, but then pick up for the fourth quarter for the holiday season. And that's where Target.
All right, let's quickly get through some other points. First of all, Target, I read that Target may post its first quarterly revenue decline. A lot of analysts cuts first revenue decline in 6 years. So maybe that, as to your point, is not the one that people are excited about. Amazon, generative AI feature that
could summarize some of the products, and they seem to be talking about that. The Barbie theme seems to be doing well. I went into Bloomingdale's, which is owned by Macy's. They had a whole Barbie and Ken area, and yeah, it sure had things that were Barbie or Ken, but it just had pink dresses by other designers. So that goes to your point of everything pink doing well. But I do want to get to some of the services like hotels. You mentioned MGM, Caesars, and some of the other names, Amazon, Ollie's. Just any final thoughts here?
Yes, there's a combination of things. When a collaboration with Centric Pricing, LSEG definitely discovered that it's not just the Barbie merchandise that is selling out. And by the way, it's selling out really well. About 36% of all merchandise related to Barbie has sold out. But the color pink has seen a spike in demand, almost twice as much than it did a year ago. And this is just because people want to wear pink for the movie. And retailers and brands are definitely capitalizing, pricing in on this nostalgia feeling, as a lot of this merchandise is geared towards adult and not necessarily towards kids. The main beneficiary to this is exactly to your point, Bloomingdale's. Bloomingdale's is the one retailer that is seeing the strongest sellout rate among these retailers. And in regards to your other question, Amazon is very well poised. It has all this information about the consumer, and therefore analysts are bullish on the company. Government is also going to report U.S. retail sales tomorrow, and we actually expect a healthy number to come out of it. This is mainly because of the Prime Week in the month of July.
Wow.
That not only benefited Amazon, but it also benefited a lot of the other retailers and brands that piggybacked on this event, which again underlines the point that we've been saying, that the consumer is willing and able to open up their wallet if they feel that they're getting a good value and discount. And this will also be the main driver behind back to school sales, if the parents feel that they are getting a good value and discount for those back to school items.
Right, Jerome Martis, great to see you. LSEG, appreciate it. Thank you. Still ahead in the second half of our show, we're watching PayPal really closely, a new CEO coming in, and we want to examine what that means for this online payment company and also the competitive landscape. As we head to break, take a look at winners and losers in the S&P 500.
Right when I said I shouldn't be trading it. Bring. $30 minutes. Hour. Barbecue's down almost 11. GME's only down 1.2 at this point. GNS is up 27. RAD down 9.7. Dish down 2.5. Liquor down 29%. It's bouncing on yesterday's low at least. Friday's low. Not a great sign though. Didn't hold a higher support really. Tupperware is green 2.7. MC down 33%. Price coming down here.
Weekly losses in 2023, but the Nasdaq is jumping today, up 0.75%, 15,140. All right, because tech is leading. Let's get Ben Lichtenstein in here, a contributor, to tell us about what he is watching in this final 90 minutes of the trading day. Ben.
Yeah, really that move up in tech, Nicole, as we saw the Nasdaq rally up to 15,177, leading
the four major indices, but not a lot of follow-through or conviction in terms of the broader basket. If you take a look, you pointed to the fact that we're seeing kind of a mixed bag here. Two of the four majors in positive, two of the four majors in negative territory. You saw the SPX up to 44.86, and you saw the Russell sell off down to 1903, while the Dow's been kind of mid-range and unable to take out the highs or lows from Friday. So kind of a slow start to the week, and we're seeing that not only in terms of today's price activity, but also, as you can see, where we are relative to last week's highs and lows as well, kind of in the middle of the range that we established last week. The S&Ps we're looking at here, futures up to, well, we'll call it 45.50 down to, we'll call it 44.50. So basically 100 points of range, and here we are for the most part just below 4,500 in the middle of that. And a similar situation as you look at where we are relative to last month's highs and lows. That high on the screen there, 46.34, is the high for the year. So you can see the pullback that we've had off that upper level and how we're now back in the middle of the range that we established in the month of July. August hasn't seen a lot of follow through, right? But this move lower here has us right back to the 50-day moving average, still well above the 200-day moving average. But again, kind of
Mercy Properninos, Yoppers. Green looks different. No, I didn't change anything. There's nothing that's different about this stuff since the update. Nice consolidation on GNS. You bought puts? Ooh, bubblicious.
similar.
May the odds ever be in your favor.
What we're looking at with the S&P, the Russell, not a lot of conviction today, lower on the day as we come off the highs recently up around, well, here you can see just shy of 85 last week, 84.89 to be exact, to 82.50 today. And in the middle of that range that we saw, so we rallied from, well, just below 80 up to that high, taking a step back from the 5-minute candles. You can see where we are on the hourly candles, and you mentioned 7 weeks in a row to the upside. This week would be 8 if higher. Keep an eye on that spike up that we saw again last week up to 84.89. Looking at the bigger picture, crude's been above the 50-day moving average, but again, relatively contained. You've got highs up around 85 to watch from earlier in April, and then should we take those out, there's a bit of a double top from last fall up around 95, but this is one of those headwinds. That's what's weighing on stocks and has us off those highs from earlier in the year, the highs for the year. And I think it's also 10-year yields holding up around at well above 4% right now, convincingly, in addition to crude at these elevated, stubbornly elevated levels, Nicole.
Right, understood. Great to see you. Ben Lichtenstein, thanks for kicking it off.
Lichtenstein.
It's a week ahead. We appreciate it. Let's switch our focus now straight over to those payment stocks. We think about fintech. Steve Bigger is with us, Director of Financial Services
Market is just
Research
eating
at
up
Argus. Thank you
liquidity.
for being with us. So, a new CEO for PayPal, and so that's Alex Chris, and then you have CEO Dan Schulman. I'll stay on until middle of 2024 as a director. What do you think about
Market
the change?
makers
I mean, he did say he was going to get out at some point this year, but what do you think of this change?
Yes, thanks, Nicole. It's a a fairly long time coming, and of course Dan Schulman gave a long lead time for his departure, and intends to stay on until May of next year, even. So some pretty good continuity here, I would say. And just looking at the choice itself, I think maybe not the most familiar name to the street or myself. But certainly, it sounds like a pretty good pedigree with Intuit and the background there in small business and payment capabilities as well, and integration of some acquisitions, which of course PayPal is known for as well. So I think brings a fair amount of good experience and background to the table here.
Right, understood. So his background from Intuit, where does that fit in? I know he focused more on small businesses and the self-employed group. Does that fit in?
Yeah, I think so. Of course, they're much probably broadly known for their TurboTax platform, but they do have small payment businesses, work with accountants, and and do have that some cash payment capabilities. So I think all that generally fits in pretty well with what PayPal does. There's a pretty big learning curve. Clearly at PayPal, obviously a leader and an innovator in the space, and a lot of getting up to speed on all that they do, and particularly I think on the innovation side, because PayPal has been very innovated as has Intuit, but certainly the buy now pay later aspect, the Venmo and Venmo credit cards, and they've launched the cryptocurrencies, including stablecoin last week. So quite a bit of growth opportunities ahead for PayPal, and again, a pretty steep learning curve.
Right, understood. How does this fit in the world of PayPal, Square, some of the other fintech names? Do you like some more than others? You could even include some of the big credit card companies.
Mm-hmm. Well, I like the payment space generally, and PayPal in particular. Where PayPal is kind of carved out its niche, obviously, is in the payment button, right? The ease of checkout at the merchant level. They have, they continue to attract merchants to the platform. They continue to increase the payment volumes, additional partnerships, for example. They've increased the number of transactions per customer. And of course, they have that long-term secular shift and tailwind towards digital payments. And that secular shift, of course, is beneficial for many in the payment space, including Square, which we also have a buy on in addition to PayPal. And some of the other background service companies like Fidelity National and Global Payments also in that space. So Visa, MasterCard, clearly also strong growth vehicles in the payment space. And these are all, I think, good long-term secular plays as something like 75 or 80% of transactions today still done in cash at the retail and merchant level. And so a lot of upside there.
So you like the group overall. Which ones do you have? Any strong buys?
Yeah, so buys, across many of the names I mentioned. So PayPal, Square, Fidelity National, Global Payments, Visa, and MasterCard are buy in the Argus universe.
I understood. So at this point now, how concerned are you about the consumer? Because we've certainly heard that, and from these credit card companies, that people have been spending. We've seen it. They're certainly spending on services and travel. Where does an economic slowdown or downturn of some sort fit in here, if at all?
Yeah, absolutely. I think a slowdown is taking place. Clearly the consumer had a big benefit during the pandemic. They weren't traveling. They had money to spend on other things. They got stimulus money from the government. Most of that is, of course, have been largely absorbed into the economy, and balances are kind of back down to pre-pandemic. But yeah, higher interest rates do bite the consumer. There's every day somebody wakes up if they have a revolving mortgage or a higher credit card payment, or they're about to take out an auto loan. These are a burden when you get interest rates up this high. So we do expect a slowdown in the consumer space. Of course, names like PayPal and Square, they've also been dealing with kind of the acceleration to digital payments that happened during the pandemic. Really pulled forward growth from a number of years. So I think that's why a big part of why that growth slowdown has occurred for names like this, and the share prices have reacted to that. But still we expect consumer spending to be positive here. It largely tracks the employment story. So if consumers have jobs, or if they lose a job and find it easy to replace one, they'll continue spending. They'll also stay current on the bills, which is good for banks. Clearly, the default rates shouldn't rise significantly. So I think consumer spending does pull back here, but does not go negative.
Understood. Steve Biggar, great to see you of Argus. I really appreciate you taking on the big story of the day, PayPal's new CEO. Thank you so much, Steve Biggar of Argus. Thank you. And nice to hear you like the space, too. Still ahead, we'll bring in our panel to talk all about a very hot topic, and that is Bitcoin and the blockchain and the delays to those spot Bitcoin ETF products. But it's been running up, right? Bitcoin ran up on some of this. So digital currency next.
Okay. Well, I just got a hedge on my long term. Got a buy 445 January put. So at the money put for January. Plan on holding that for months at least. Might do some like 4-man covered puts on it, I guess. I don't know how you'd say that. Selling some shorter dated puts. I think there's a bottom and we'll have a shorter term rally.
And then you saw Bitcoin getting a boost on that. And what do we have? Like 8 ETFs sort of waiting for the approvals, but we see delays at this point. What does it mean for investors?
Great question, Nicole. It's been a bit of a who's who in terms of all the different companies going out for this spot ETF application. I mean, we have BlackRock, WisdomTree,
around though.
ARK
like
21 shares was recently delayed. Looks like through September. VanEck, Fidelity, just everyone. And I think for investors right now, that's really the next big catalyst. The whole digital asset market is waiting for this approval. And in the meantime, we have a fairly light macro calendar this week. It's August, sort of the bit of the doldrums, the low of markets broadly speaking. Bitcoin right now is realizing a similar volatility to TLT, the U.S. Treasury long bond ETF, which is just amazing. I mean, here Bitcoin's usually an 80 vol asset, and now we're in the 20s alongside TLT. So really, the market's just waiting for those applications to go through for the next upside catalyst. We're also seeing Ethereum futures ETFs being filed as well, Ethereum plus Bitcoin futures ETFs. So there's a lot of product that's waiting for approval, and that's really the next tree of catalysts, in my view.
Yeah, and it almost feels like when will those approvals be? You know, this is almost like the cannabis story. I mean, people have been waiting, for 5, 6, 7 years for more on cannabis, and they've gotten crushed in the meantime, waiting for approvals and regulation to go their way. That being said, we are expecting a halving of Bitcoin in April of 2024. Sometimes that's a catalyst. Emil, what kind of catalysts are you looking for in the crypto market? And are you a believer? Do you like this group?
Absolutely. So obviously, one of the catalysts will be the halving, which will probably come to pass sometime around April, May next year. And usually what does happen when you do have a halving is the price soars, right? So that is one certain catalyst. But then we have, of course, the discussion going on right now with the ETFs and what is happening both on the Bitcoin and the ETH side. So when this really gains momentum, there's a lot of capital looking to move into.
We've talked about it a little bit.
I would say I am bullish on crypto right now, and most I would say
steel broke out there.
Experts are. The main reason is that there's actually a major utility.
1 billion steel ore will be forged in fire.
So it's not just
Even close to the best strategic buyer.
Been marked by volatility over the years, but as more senior investor firms are coming in, such as BlackRock, et cetera, then the maturity of that market essentially increases the stability of it as well.
So at this point now, I know you can't give exact recommendations, Todd, but at this point over at CoinDesk, I mean, for example,
yeah, I guess not a whole lot to talk about. I don't understand it the whole like that in depth.
Maybe a little more lately, but even during the whole FTX collapse, it seemed to, and NASDAQ was going
seems
nuts,
like the share price of Ape and AMC have to
last
basically
year,
converge.
It really has sort
And
of
that's
held
where that
its ground.
arbitrage
In the
play
meantime,
came in,
Shiba
and
Inu
we
has
got
been
approved.
surging
But we
more
saw
than 25%
this dump and the Ape rip.
since the last month or so. So what's going on? I mean, are there certain areas that you think are better for investors as rates have been on the rise?
Zip was saying they don't need liquidity.
It is.
So I'm not sure where he's coming off with that.
Rates have risen. I mean, now the 10 years at
Seems like they
near
do, but
near-term
if they
high
don't
as
and
it
they're
was
just
last
raising
fall,
capital for themselves,
mortgage rates,
that's
30-year mortgages
pretty bearish.
is up at similar levels. Rates have moved up, but both equities.
Not sure though. It seems like they probably do.
Again, for that spot ETF news, and generally when we've seen
That's smart. I
whenever
thought
we
it was
see the majors, the
Cleveland
Bitcoin,
Cliffs.
Ethereum, sort of be range bound.
Oh, is that a new buyer?
That's when we see digital asset
That's
investors
smart.
move into side bets and into altcoins, into meme coins. May, for instance, Pepe.
A little bidding
Pepe
war
was
going
another
on.
token that was surging quite a bit. So not unexpected. Shiba currently is that meme coin of the season, so to speak. But then when
Need to average down
the
by
majors
8.
start to move, then
Maybe. I'm not sure how
investors
much of the
consolidate
arbitrage
back
is
to
still
those
a
household
play.
names, Bitcoin and Ethereum. So in the meantime, it's there's a little bit of
You know,
trading going
you
on
missed
around the
a pretty
edges,
big portion of it.
but overall, we would see the next leg up in the broader market to be driven by the mega caps.
Yeah, Emil, I'll give you the last 10 seconds. Final quick thought. I know you had a lot of Web3 on here too. Quick thought.
Yeah, I mean dilution.
Well, I couldn't
usually
really
is good
agree
for
more. I mean,
shareholders.
we have a massive
If the
influx of
company needs it
capital
though,
into crypto right now.
in the
That
long run,
will
it could be
probably
good.
continue in the year to come. So
If it
I would
keeps them
hedge
out of
my bets
bankruptcy.
on crypto increasing in market cap significantly
Wow, that's
over
crazy.
the coming 6 to 12 months.
That's a good call.
Todd Groth, Emil Eggson, thank you so much. Wonderful to see you both. Thank you very much. Todd of CoinDesk and Emil.
35 a share, and here it goes up to
Good
35
to see everybody.
probably.
Thanks for being with
Somewhere
me. I'm
around there.
Nicole Petalides here on the watch list. I'll see
34.
you tomorrow at 11 a.m. But keep it right here.
Crazy.
Market on
3 minutes for
Close.
Power Hour.
Oliver Rennick is next.
Okay, Power Hour. Where do we go? We're already at VWAP pretty much. Just chop around probably for your stop losses. Continue to eat up retail.
The Nasdaq's doing fine. A little resurgent rally in Nvidia is carrying the chips and the market ahead of a week that is pretty lacking in terms of obvious news flow on the calendar. There's just not a lot.
They changed his mic. He sounds way. Turn the bass way up.
Though, of course, we'll be keeping an eye on earnings
move his
and
mic
economic
a lot
data.
closer or something.
Mostly just watching bonds to see if anything exciting happens before Jerome Powell goes to Jackson Hole. But today, bonds have calmed down a little bit since the morning. It looked like we were going to get some fireworks possibly early. And we do want to keep watching the yield into the close as the 10-year is back higher, but it hasn't really been an explosive move. We're down 20 bips right now, so markets can probably take that in stride after some of the big sell-offs we've seen with 10-year futures down upwards of 1% the last couple of weeks. 20 bips is, I guess, manageable right now. Economic data this week, fairly light. We do get retail sales and we do get retail earnings as well. Walmart and Target are going to be a couple highlights. I'm going to be watching Cisco very carefully as we do have a winner in tech sector report. And with Walmart, too, being a winner, you do have two big cap companies that might be able to tell us a more encouraging story than some of the others that reported this earnings season that have generally been letdowns. That's why the bounce in NVIDIA today is important because it's got the chips back up 2.5%, a group that's really been lagging. Cloud stocks, though they were up in the first 7 months of this year alongside the chip makers. We will start to get some of those numbers out with Okta and a few others. So obviously we're still watching those two major components of tech. But the giants don't have any big earnings this week. However, NVIDIA is not too far away. And so after a little bit of a downdraft in earnings the last 10 days, the possibility that we get chip makers and NVIDIA and others to strengthen up here going into a week with a big winner like Cisco certainly seems possible and maybe gives an opportunity for bulls to make a stand. As I said last week when we closed out on Friday, bulls certainly have been shaken here, no question about it. But there hasn't been a lot of deep bearish conviction either. As we've been drifting lower off the highs, we haven't had any major big down days, 1% here and there. It's not obvious that we're entering a bear market by any means, but it certainly is obvious that the upward momentum is stalled out. And that's where we're at here going into this week. I'll be watching the dollar very carefully. Let's look at the chart there because there's a few levels that I think are pretty clear that should be helpful to us in assessing whether or not the bounce back in the economy creates problematic inflation. Dollar right now is at 103, which is already getting kind of interesting because last month the dollar's big decline in the first week of July took us from 103 all the way down to sub 100. That's the big red sell-off we got there. Now for market bulls, that was welcome because the dollar's downdraft signals the passing of the hawkish baton from the Federal Reserve to others around the world and an acknowledgement that Jerome Powell would be nearing the end of his hiking cycle. The fact that the dollar now has come all the way back to where we were before last month's big drop-off and before the high in the stock market, which was on July 27th, which aligns right there with the near bottom of the dollar, I think tells us something important, and that's that the narrative might be shifting on the expectations for the Fed. We'll be talking about some of that macro stuff and the data points we get this week, and we'll be listening to Neil Kashkari tomorrow and any of the other Fed speakers. But Powell at Jackson Hole gives still a pretty good chunk of time between now and then for the bond market to either apply pressure so that when we go into that event, Powell's forced to say something more aggressive, or if bond bears can't take yield past the one-year high up to a fresh new 4.3% or plus, then maybe Powell can stick with his pause language. I want to also point out the way the market's been trading around some of the big sell-offs in bonds. We know that the NASDAQ has generally been inversely linked to yields. The market topped out, and the S&P topped out as yields bottomed and had the jump up to 4%. So we know that relationship still generally exists, where the tech companies don't like the yield to go up too fast. But it's also important to watch the regional banks. Given the risk around that group earlier this year and the connections to higher interest rates pressuring those companies, the regional banks this morning were getting slammed. Now, they're up a good bit since earnings, and they're doing okay. The KRE ETF trading above $45 is kind of my threshold here given that's where the big drop-off from the first quarter brought us down to in the ETF to around 45. We're still above that. But the responsiveness in regional banks to the sell-off in bonds this morning was kind of interesting. Bonds sold off pretty hard. Regional banks sold off hard too. And then bonds started to firm up. So there might be something there. There might be a little bit of a nugget there we need to watch of information the market telling us, which is that the next move higher in rates might not just apply pressure to tech companies like we're used to from last year, but we might see the market associate financials and regional banks in particular as a risk for higher rates if that environment does come. So something to keep in mind. Otherwise, it's a pretty mixed market, and you have some firmness in tech that's helping out today. Not a whole lot else to say. We're going to talk a lot of stocks this afternoon as well. We're going to hear a short case on a business from Ben Axler pretty soon here at the top of the show. And we're also going to be talking about some macro connections into the banks with Axel Merck, who will be joining us as well. Right now, let's bring our team in. We got Kevin Hanks and Renita Young standing by. I think probably we should start with that NVIDIA story, Renita, because it's really waking back up. And that's definitely helping this market a ton after the stock kind of stalled out. So where's the optimism coming from?
Well, it's coming from a Morgan Stanley note calling NVIDIA one of its top picks, but also naming why it's a good time to buy Morgan Stanley. Now, the analyst by NVIDIA, the analyst at Morgan Stanley, says that even though this company had a recent sell-off, that actually provided a good selling or buying opportunity right now for the company, for anyone who would want to get into NVIDIA. And then secondly, Morgan Stanley thinks that this massive shift in spending toward AI and the supply-demand imbalance should help drive growth for the next several quarters. In fact, Morgan Stanley says that despite some supply constraints that had been existing, analysts, they still expect a meaningful beat and raise quarter for earnings. Now, they're expecting revenue to come in at between $500 million and $1 billion more than what the company guided for. And that would be revenue of about $12 billion at the high end. And they believe that it'll be driven by data center demand. Now, looking forward, Morgan Stanley is expecting strong revenue for NVIDIA over the next 3 to 4 quarters as well, in that they say the implied $7.5 billion in quarterly data center revenue is trending to be more than $15 billion over the next few quarters. Now, this stock, as we know, it's extremely hot. It's up more than 190% year to date. And this analyst at Morgan Stanley, while they did not change the price target, they still believe that it'll go up higher at around $500 a share.
You know, the reference to the data center side there, I do kind of wonder if that's enough. Kevin, what do you think? I mean, we heard all this about the AI revolution. I mean, shouldn't we be hearing more about like new products, new demand, if it's just making the data centers better already? Wasn't that already part of the plan, like over the last 5 years? I get the optimism certainly helping the stock, but feels like we should have something a little bit more revelatory here to justify this move.
Oliver, though I will concede that NVIDIA is the leader in innovative chips and AI and so many important high-profile parts of this economy, AI is a promise to the future. And NVIDIA may be the first to get into AI and start really benefiting from AI as they sell the chips to make AI. Boy, that's a tough to come screaming back into this stock at a pretty significant correction here in NVIDIA, but still up big percentages for the year. So, yeah, I'd be still a little bit concerned and very risk-defined about trading NVIDIA right now. I'm looking for something other than just the AI story, but the AI story is the wildfire, Oliver, that's spreading throughout the markets, and any reignition of those talks, you see what can happen. NVIDIA up 6% today. So, listen, the volatility in this name is going to continue. It's lifting up, Microsoft, very small move today. Without NVIDIA, I'm not even sure the S&P is up today. Oliver. Matter of fact, I'd make a pretty big bet that it's not up today. Yeah. So it's really close. Right. You've got Apple up a little. You've got the Magnificent Seven, everything except Tesla up. But, boy, not up very convincingly. So, NVIDIA is a great story. And it's an unbelievably great company. But the leader in the space.
Head and shoulders on barbecue on the hour.
NVIDIA could be
below that resistance.
The greatest semiconductor chip story ever told. But just like Netflix, who's the leader,
I called it earlier on. It
could still be $250 off its high.
Hoping it wasn't the case, but back to safety at VWAP. An hour and a half before close.
The hope for NVIDIA and the
dance around, but
is
this is where it wants to close.
Unlimited. That doesn't mean I want to buy the stock here, Oliver.
Well, I mean, look, there's no debating that now there will be leaders in basically all the main secular
kind of giving up
markets for chips, and it seems like they're going to be particularly
really strong
ahead on AI relative to even some of the others and the more class groups like the data center and the gaming and graphics. The thing that I thought was interesting from this note, we need to come back to it for a sec, is the fact that they specifically, the analyst, calls out their last earnings, the huge guidance bump that they gave, and basically said that they could put something more on top of that, which to me would be like, all right, then the bear case for this stock is totally toast if they could actually give another guidance uplift, right? And that's what this analyst is saying.
They're talking about between $500 million and $1 billion over what the company guided for. That would be huge.
Right, well.
I think we would probably see, we would probably see a big stock pop right off of that. But how much higher can this stock go before it starts to retreat a little bit? Are there any technical levels that it may be brushing up against that could complicate the picture?
Yeah, that's the problem when you've just been going ballistic. You leave all the levels behind. So, all right, that being said, as far as the rest of this week goes, we've got Cisco, we've got Walmart, Target. We don't get NVIDIA for 2 weeks. So, Kev, I'm still kind of like in this look-ahead calendar mode because we get NVIDIA at the same time as Jackson Hole. What's going to move us this week, Kev? Are we going to get any excitement?
Well, it's got to be retail. It's got to be Walmart, Target, Home Depot. Later in the week, John Deere, or Deere & Company, I guess it's now called. That's another good name. But if you're looking for the big high-profile names, they're out there. These are high-profile names that I just mentioned. They're just not the same level of excitement as large-cap tech. So you're not going to get the same inertia that you got from some of those names, Oliver. But there'll be great stories. Retail sales tomorrow morning and then Home Depot tomorrow morning. That'll be fun to go through and look at because they've had, Oliver, lower sales but higher prices, making their numbers look better. And Home Depot, look at the chart on that stock. It's had a pretty incredible run. Still nowhere near their all-time high, up around 420, but still a really good run after a big sell-off. So I think Home Depot will be fun tomorrow.
I actually do think that one's really important, too. That might be a little bit of a sleeper event because they don't miss, as Kevin Green told us earlier this morning, 8 out of the last 8 quarters connected to the housing trade, which has been robust. So you expect it to do pretty well. Same kind of story with Walmart, threading that needle of where the consumer's at right now and their spending habits. So a couple consumer and retail names that should be able to hit the mark. And if they don't, then, maybe we've got a story. So, all right, good start here to the week. We found one mover today. Thank you very much. I'm needing Kevin. Good stuff. Thanks, team. Let's bring in Axel Merck, President and Chief Investment Officer at Merck Investments. Axel, I'm looking at your note, and you got a lot of interesting macro subjects. So let's start with one, which is the banks. I was noticing today that there seems to be a little bit of sensitivity in this group still on days where yields start off higher, bonds are slipping.
See you later, Jay. Thanks for cruising by.
Get mixed up in that still.
Is
this a concern that if rates go higher, the group will be back under pressure?
Great to be with you. Well, the concerns I have on the banks, on the small banks, I don't think they'll quote-unquote blow up. We know that they will get bailed out. But imagine if you're a small bank, you're already drowning in red tape. You haven't been particularly good in managing interest rate risk. You have a lot of exposure to commercial real estate. Now, granted, the loan-to-value ratios are decent. But if you have several properties that are in receivership, you're not going to be all that excited to lend. And the question to me is, that is a headwind to the economy. How big a headwind is it? because if you're a small business, the big banks can't can't serve your needs. So small and mid-sized business will have to look elsewhere. Now, we heard in recent days and weeks this creations of large private credit funds. Maybe they'll step in, but this just adds to the headwinds, and we may not see it in all the numbers at this stage. We do see it in things like the senior loan officer surveys are not exactly turning better. Credit spreads haven't blown up, so I'm not concerned about banks blowing up. But banks, small banks, have serious issues. They're not being addressed. The can is kicked down the road, and that will be a headwind to economic growth.
Are they issues that only arise with the blowout in rates? Are they issues that are exacerbated by higher rates? Or are they just issues that are going to happen no matter what rates do?
Well, no matter what rates do, I mean, the rates will always do something, right? Let's just talk about that for a second. You keep talking about Jackson Hole. Do we even know yet that Powell is going to speak? I don't think he's on the calendar yet. They don't publish the calendar until just briefly before the conference. I think we all assume it. Let's not forget that historically, always, Jackson Hole is a creation of the Kansas City Fed. Now, that used to be under the leadership of Esther George. She retired earlier this year. Now it's an interim leader until the end of the month. So presumably, if Powell wants to speak, he gets to speak. But this is a club, and what they want in this club in Jackson Hole, they want new information. Well, guess what? As a market participant, wouldn't it be great to get something a little bit more tangible than higher for longer? So higher for longer is not a strategy. I think I've mentioned this in your program before. And now we are at this higher
16%
stage.
today, that ain't bad.
What's next? There is no rule. There's no reaction function. And so if you ask me the question about the banks, sure, it matters what the Fed will do. The only thing we know right now is that
Airlines is buying them.
They'll be slow to react. And if you're a small bank, you'll have to take that into account. Now, can something, quote unquote,
that's right.
that's a CFA level report term. In the meantime, of course it can. There can always be some shock, or it can just be that suddenly the glass is perceived to be half empty rather than half full.
I like that. It pertains to half empty or half full. Right now, I see the main difference between the market's expectations for rates and what the Fed has indicated is indeed that higher for longer, where there are now cuts still getting penciled into next year. One of the top stories on Bloomberg today is about Goldman saying it's going to happen.
Barbecue up a little bit above VWAP there.
Next year
we're
for
down
the
7% now.
I kind of wonder, Axel, if the market keeps pricing in cuts, does that just push them back indefinitely? If there's this sort of put underneath sentiment that, oh, the Fed's eventually going to cut, well, then asset prices go up, wealth goes up, and we keep a bit under inflation. Am I crazy?
Well, I mean, everybody's reading tea leaves, and that includes the folks at the Fed, and that's part of the problem, of course. The real problem with high inflation is that it's not a linear process. So we can all hope that inflation is going to come down, and it presumably will over time. But if your strategy is higher for longer, it's likely that at some point, some inflation prints will be higher than expected. So what's the market going to do then? It's going to have a fit because everything needs to be revised. And that's where the Fed is adding to the volatility in the market by not having a clearly defined strategy. In the meantime, the market does what the market's got to do. These higher rates will have to have an impact at some point. Remember, some of the COVID benefits are only running out now. I mentioned the headwinds induced by the small banks that I think people are underestimating. And so, yes, we're going to get what we always get when the Fed is higher for longer. We're going to get a recession. And I just don't buy the soft landing scenarios at this stage.
Okay. What about the not soft landing, not hard landing? What about the no landing or the trampoline bounce, as I've been calling it? Do we get a potential strong enough recovery
coming up there.
that we're back in a situation
today.
Last year where maybe this pause looks like the way the Fed treated transitory, where they let inflation stick around too strong or
this morning in the first hour.
Too much? Is that a possibility in 6 months? Maybe even fewer?
Range.
Well, sure. I mean, remember in the early 80s when Volcker raised rates to the stratosphere, even then inflation didn't come right down to 2%, whereas somehow we're supposed to be in a new world. It's all just short term. Inflation is going to come down and we live happily ever after. In the meantime, of course, we still have these undercurrents that not everything is back in order, especially in the services side. The question is, will there be more wage inflation? If you look at Europe, I would think the answer is clearly yes. Here in the short term, the answer is yes. How will that play out in the medium term? It remains to be seen. Again, it's in the context that when the Fed doesn't have a strategy, there will be more volatility. I also like to remind people we're currently in the most boring time of the year. The only thing that's not boring is in August, some invasions have happened in foreign nations. But when people come back to work in early September, suddenly they look out to next year. And then they see, oh my God, rates are high. Maybe economy won't be quite as strong, and who knows, right? Then suddenly we have the glass half empty scenario, and we may not have fixed all the issues that are underlying. I've talked in your program before about stagflation. People don't mention that anymore, but that risk is not completely off the table, I don't think.
All right, very crucial point here. And also like the seasonality point. Makes me feel a little bit better about not being able to find a monster story today. It's kind of the boring time of the year. Maybe that changes if Powell
that's
gets
when
on
you want to
Jackson Hole,
prepare
maybe
for the
not.
bad times, right? That's when you want to prepare for the volatility ahead, when it is boring.
True.
Yes.
All right. Thanks a lot, Axel. Good conversation. Enjoy it as always.
My pleasure.
Axel Merck from Merck Investments. All right, let's get very micro when we come back and examine the latest short report on Xylem for Mr. Ben Axler at Spruce Point. The second time.
Strong sell opinion on essential utilities, ticker WTRG, and that one is performing
That's right.
in line with our expectations. The stock continues to go down, and in fact, one of the acquisitions we said they had planned, they kicked the can down to 2025, and so that's playing out as expected, and now we have a new one called Xylem.
Huh. So what's the deal with water, Ben? You got a problem with water? I mean, is it getting replaced by all the energy drinks, or is it just an industry nobody thinks to look for wrongdoing?
Well, look, we're very forensic focused on companies that we think are exaggerating their prospects and really experiencing fundamental issues. And that's exactly the problems we see at Xylem. Xylem is a spin-out from ITT Corp, which was a complex conglomerate in 2011. Ever since that time, we've seen nothing but restructuring charges run higher than expected, capital expenditures running low, and we see liquidity challenges and ultimately financial strain through rising days of inventory and high inventory to sales ratio. And that resulted in the acquisition of Evoqua, which we believe in and of itself had problems. That was a private equity sponsored roll-up that we believe the company paid an enormous multiple for in a highly dilutive transaction by having to increase their share count by over 30%. So we don't see a path here to value creation. This is primarily a cost synergy transaction. We see no revenue synergy opportunities, and as a result, we just see a company that's set to disappoint investor expectations, and that's why we have a short thesis and see easily 45% downside risk.
Okay. One of the analysts has responded, which they almost always do. It's kind of suspicious sometimes how quickly they are to shoot you back down. But the analyst from Baird says that you've uncovered nothing new. I will say, when I look at the report, when you see the risk reward, is there a smoking gun here? Is this just like, hey, the stock doesn't make sense where it's at, it's an easy short?
Well, they say they covered nothing new, but certainly we haven't found a single analyst that addressed many of the issues that we raised, and the stock only has a 2 to 3% short interest. So it tells us that the market's really missing the story here. And the story here is two troubled companies that are combining that are really offering not much upside in the way of revenue synergies. The company's talked about the possibility, but based upon our research, which involves talking to former employees that are knowledgeable about the business, we see no revenue synergies. We also think that the cost synergies haven't been fairly represented, because the company's got to spend $90 million or more just to obtain $140 million of synergies. So that doesn't look attractive to us. And ultimately, this is one of the highest valued stocks in the industry. So we expect it to underperform the water sector. We expect it to underperform the S&P 500. It's a great relative value short. It's easy to hedge. You can be long the S&P 500 or long the industrial sector as a whole. And this is a name that should just underperform. And just look at the recent quarter, okay? The company came out claiming that they're raising guidance and strong organic growth and, earnings per share guidance going up, and yet the stock's going straight down. So what does that tell you? It tells you that the smart money here really sees that there's a problem and they're running for the exit. And don't just take the smart money, look at the CEO, okay? Right shortly after the deal was announced in January, he began a stock sale program. So we would never invest alongside a CEO who just announced a $7.5 billion transformational acquisition and isn't even keeping his money in the company. I mean, you should be running for the hills, and that's what we think the smart money investors are doing here.
Okay, and one other thing to this point about management. The company that they bought, Evoqua, is currently under investigation by the SEC. What are you looking for there? What do you expect to play out there?
Well, no, let's be clear. They settled revenue fraud charges from the SEC, okay? And that was for earlier periods. And as of their last 10Q, they disclosed that they're under continuing federal investigation. So that's another.
I see. Okay.
That's another potential overhang here that you have to get comfortable with, okay? But setting all that aside, I think our biggest concern here is the actual liquidity of the company. In the proxy statement, they had represented to investors that they could retire all the debt from Evoqua, that they could pay all the transaction costs, et cetera, from cash on the balance sheet, and that there would be no net leverage. Well, now look at the first quarter here. The debt is $500 million more than they represented, and immediately after the last quarter, and this is just last week, they filed a updated shelf prospectus. So that kind of tells you this is a company that needs money. Furthermore, we look at how they're presenting their financials. You can look at their quote-unquote adjusted free cash flow and look at the amount of adjustments we have. We think many of them are egregious, but fundamentally, this company is burning cash, and that Evoqua, which has already contributed something to their financials, is now losing money. So we see the acquisition already growing problematic. And I would just leave one other major point here. they say that the Evoqua business, particularly the integrated services business, they call it high recurring revenue, and they say 75% of this business is recurring revenue, and yet this was the only segment they could not give organic revenue guidance for. So I don't know what it means to have recurring revenue, but if you can't give me revenue guidance for a business that's 75% recurring revenue, like, you really have to be asking yourself, what is this business and why did they take 20% of this segment in charges for the quarter? It really looks like something's wrong here.
All right. Well, Water G is down near the lows, so your hit rate for water shorts right now seems to be at least 1 for 1. We will definitely be keeping an eye on Xylem going forward. Thanks for the update, Ben. And per usual, we'll also extend an invite to the Xylem management team to come on and defend the case and talk about the business. Ben Axler, Spruce Point Capital Management, coming up. Let's trade some options. One bear trade on an up day for semiconductors. You probably guessed what it is. It's Intel. But there's bullish trades also in the market. We'll talk about when we come back. Once again,
advantage of the move that we're seeing here today to put on that bearish bet, but they've given themselves a lot of duration on this trade.
Yeah, it feels like maybe this trader's still trapped in the 2022 paradigm. I mean, Intel's doing just fine. I don't know what else folks want from it on the year. It's not the great gangbusters winner of NVIDIA, but still up 33%. So, it's keeping up with the NASDAQ almost. All right, let's talk GM. Bullish trade here. Same with U.S. Bank. You got two other bullish trades. General Motors and Ford last week were really in the headline, for nothing good as far as the stocks go. Maybe for the employees, maybe if there's a deal that gets ironed out, but the shares have not been a fan of all the labor discussions.
Not at all, and that comes to fruition starting in 2024 when they're going to have to rework that deal. And we saw what happened, Oliver, with the Teamsters and UPS. The Teamsters got their way. This is an administration that is pro-union at this point. So the leverage that a lot of companies typically have in those negotiations might be out the window, especially finding quality employees for a lot of the production work that they do. That, and on top of it, Oliver, you've got Tesla lowering prices on some of their vehicles over in China, right? When does that move back over to the U.S.? I mean, we've already had a bunch of price target cuts in the U.S., I think up to 5 by Tesla so far this year. That might be putting more pressure on some of the legacy automakers, including GM and Ford. That's also a concern. The stock's basically up about 1% this year. It's not doing well at all, and that's a concern moving forward. The company did just recently report a strong beat. They raised guidance for their quarter, yielded the most positive takeaways that the street's gotten, recently out of any of their reports. Stock did pop on the initial news, but now back below that
what kind of positions are you talking
earnings
about?
levels. So not a lot of love here, but maybe somebody trying to take advantage of this overbought scenario because the RSI on this on a technical basis is below the 30 level at this point. So technically oversold at this point.
Thanks.
Trader was in there buying the August 25th. That expires in 11 days. They bought over 8,035 strike calls. Average debit of just 38 cents. Not a lot of option premium that you have to pay for these. Break even about 35.38 over the next 11 days. That's only about 4% above the current share price in here. And as I mentioned, the RSI severely oversold at this point. It's below its 50. It's below its 100. It's below its 200-day simple moving averages. So, yeah, not a lot of love here for GM, but this trader is probably thinking over the next couple of weeks that we're going to see a bounce in the stock.
All right. Yeah, oversold, really got slammed
climbing up
last
there.
week in particular. GM just lost the footing. Ford, basically same story. It was trading at $15 just last month. Now down to 12. So pretty well stuck at both these companies. All right, what about the banks? Tommy found one. Someone's buying the dip in. A USB down 2%.
Yeah, after the Moody's downgrade of some of these regional banks and some of the other banks that were put on watch, including USB, it's been a concern for this company. It's down about, 11.5% so far this year, even though it's made up some ground since those lows that we saw in March when a lot of that regional banking mini crisis came about. But, many banks' second quarter results showed growing profitability pressures. That's going to reduce their ability to generate internal capital. Loans drying up a little bit. You still have that overhang in commercial lending at this point. So there's a lot of headwinds for this company. But I did see somebody maybe taking advantage of this in this weakness in this stock, not only today but so far this year. They were out there buying the October 40 strike calls. Over 10,000 of those were bought for an average debit of about $1.50, so that break even of $41.50 over the next 67 days, about 7.5% above the current share price in there. Call volumes more than 3 times normal daily average volume that we've seen over the last week. Has that 5% dividend yield, Oliver, also, so maybe lucrative to some, but I think there's a lot of hands off from investors on this, on a lot of these banking stocks, especially after that Moody's report that came out. But that being said, somebody trying to take advantage of maybe this downturn today, and trying to buy some upside calls here. They've got the duration, too. They've got over 2 months in this trade that they put on here today. So, somebody thinking that this stock can eventually rebound here, but still a lot of headwinds out there for some of these regional banks.
Yep, we just heard the case from Axel Merck. Not convinced they're out of the woods yet. So this trader's got other things in mind. Nice to see, though, a little optimism here for the group. So someone's buying the dip, and definitely a dip day for the financials. Thanks, Tom. All right. Looking for some upside in U.S. Bank and General Motors. Fading, though, the strength in Intel today. Coming up, Jenny's going to give us the latest on Netflix and how it's dealing with keeping people in to pay a full price, and also the strike and the lack of writers. Maybe that's putting the pressure on them to move that video game business forward faster.
SPY climbing up there. You buy back in yet? By waking up in the last 15 minutes. See if it breaks the high of the day. GNS up to VWAP. Wait almost 2 hours for this move. Almost through here. Not a good entry. And I'll play on SPY today. One reason why a lot of day traders just trade in the first like hour or two. In case you end up with a day like this, which happens.
In the coming weeks, but the games that will be part of the initial tests are Oxenfree from Night School Studio, as well as Mullenhugh's Mining Adventure, which is a gem mining arcade game. Now, the VP of Games said on Netflix's website to play their games on the TV. They're introducing a controller that they already have in their hands most of the day, our phones. And as a result of that, members that are using computers can operate using naturally a keyboard and mouse. The company did initially roll out its mobile games back in 2021, but it's been pretty lackluster so far. I know that Netflix has a lot going on. I understand expanding your offerings. I just don't know if this is enough to move the needle here, frankly, because again, they're entering a well-established, very loyal, very scrutinized space.
All right. Well, I have to say that seems like a good plan, seems overdue, but The oxen-free launch titles give me a little PTSD when people used to say "Ollie Ollie oxen-free" when I was a kid. Freaked me out. Never knew what that was. Let's bring in Chris Robinson. Thanks, Jenny Horn. He's the managing director at TJM Institutional Services. Chris, good afternoon, sir. We've got markets trying to firm up. A dollar that's lost a little bit of its mojo earlier, but still up on the day. When does this start creating problems for the commodity markets?
Well, you got to remember, we just dropped 13.5% in a year, right? We were at 114.75, made that low at 99.75, basically, roughly 13.5%. So in this last month, we've gone up 4 points or 4%. So is that enough? We got a long way to go to certainly do anything, real damage to the downward slope that we had. But for now, 102 is the new floor. We popped through that. That's technical. Anytime the dollar goes higher, it's automatic. It's a knee-jerk reaction for people to say, "Oh, that's why commodities are down." One of the reasons, there's a lot more reasons than that. It's one of them. It's kind of a simple go-to, but it's more complicated than that. So I would imagine that, okay, if we're up 4%, but based on where we were, a year ago, the dollar is still cheaper, a lot cheaper than it was.
Okay. The July move that happened so fast to the downside, now that we've closed that back up, seems to tell us something related to the Fed, right? I mean, it seemed like that was when the fever pitch, hit for pause, skip, end of hike cycle.
Right, and the last inflation data that we got this week, people are saying it's slowing down. Problem is the Fed going to lift their foot off the pedal? Probably not. This is when it gets into the politics of, are they going to stay higher for longer, too long? No matter what the Fed does, they're going to be criticized. At the end of the day, I think that we're going to continue to watch the employment. I mean, that's the key. So the U.S. dollar does not believe that the Fed is done hiking. So that's why. I mean, I think that the dollar would probably start to drift lower, but that's also a pretty good indicator of what the market's feeling. And for now, I think I would watch that. Are they going to hike another 50 basis point? Is that going to be the literal or figurative straw that breaks the camel's back that puts us into this recession? I don't know. That's above my pay grade. But just for a simplistic, trade, there's that 102 level is key. Broke through a big trend line. It's August, so the technicals come in when the market thins out a little bit. We've seen a big decrease in volume in trading commodities, especially in the grains. When typically this time of the year, we're getting busy. So a lot of speculators have been beaten up here, especially in the grains.
Yeah.
Last
wheat.
Wheat,
Chris.
Exactly. It's wheat and corn. We just had a supply and demand report on Friday, which came out, and there's more corn out there. The carryout, it was all about the carryouts. Carryout is projected that we're going to have more corn. We've had kind of a tighter corn supply in the past year and a half. That seems to be abating. We still have a tight supply for soybeans, and that's why soybeans are the one positive if you look at the grains. But wheat just cannot, no matter what happens on the world stage, every time you think this is it, you're going to want to be long wheat because of what's going on in the Black Sea. It just gets hammered again. So we're at 2-year lows in wheat and corn right now. You'd be like, oh, I want to be long corn and wheat. And it just has not played out that way because at the end of the day, supply is bigger. We have more of what the world wants less of right now.
I like that. It seems like that is indeed the case. It just can't get it started for that particular commodity product. Corn, kind of same story. So it looks like right now it's crude oil as the bullish trend in commodities and pretty limited elsewhere. Thanks, Chris. Like the context. Good updates here. Appreciate it very much. Joining us from TJM Institutional Services, we got our Schwab panel coming up next. Less than 10 minutes till the bell. We'll set up some of the events for this week, try and find out where the action is going to be and whether or not Jay Powell's even going to talk at Jackson Hole. Be right back.
Let's walk through how to analyze a company's financials on Thinkorswim. To get started, go to the Analyze tab and select Fundamentals. Enter a symbol, then select Enter. To download detailed analyst reports, select Download. By the Numbers provides balance sheet information and other fundamental data. Company Details provides summary takeaways on key metrics and what drives the stock, takes a more numeric look at similar information. If you find any of the information particularly helpful, you can print it out or take a screenshot. For more demos on how to Thinkorswim, head to the Education Center on tdameritrade.com.
Trading has changed forever as a new generation of investors make their impact on markets.
It's more important than ever to navigate through the frenzy of meme stocks, IPOs, and the next wave of tech.
And that's where we come in, discussing strategies and example trades on trending names.
Take control of your financial future. Next Gen.
What's up, Emperor? GNS above you up there. Joan? Yeah, I picked up Joan the other day. That's not doing very well. Had a weird move with RAD. Wonder if they're in the same basket. They're both kind of selling off together too. Jeez, RAD. New lows, new flushy. Oh. That's not good. Yeah, it's not good. It broke that. Dang it, Rad. That's right, Emperor. Sucks. I think these are in some sort of basket together. The dates, their charts, very similar. Just since they both turned on the second. Three-day move, is that all you get? With no news? Eyes climbing up there. Close to the high of the day again.
Bank presidents, where we really have an idea in real time of what they're looking at. So we kind of know where everyone stands right now. So as we're a few weeks out right now, really just a little over a week, I'm not sure what new we'd get from Powell. It's not like we'd get any sort of structural change or a change in the inflation target. They've sort of brushed that off. I think if he does speak, it would more be about what the outlook is going forward, and that they would expect inflation to continue to hit their 2% target. And he'd probably talk maybe more about the growth and labor side of the market, because inflation's moving in the right direction, but now all the focus appears to be on the potential for a soft landing or potential re-acceleration in growth. So that's what we'll be watching for at the symposium.
All right. Gotta say, I feel like if Powell didn't speak, it would be an implicit admission that he thinks all the challenges are behind us.
Got 3 minutes to close.
Pretty nuts, but what do I know? Nate, what do you think here? Are stocks waiting to worry about bonds until they hear more from Jerome Powell, or is it just a matter of seeing if our 10-year breaks out to a fresh one-year high? What's going to turn a stall out in the bull rally into an actual reversal What has the power to do that?
Well, I mean, near term here, Oliver, I mean, we've had a pretty decent sized pullback over the past 2 weeks or so. And then if you look at the charts, the S&P, the NASDAQ 100, and the Russell, they've all come down to their 50-day simple moving average, which would give you, in terms of, if you think of a near-term trading perspective, risk reward. If that 50-day holds up as support, then maybe this is a good time to look in for somewhat of a bounce from the recent sell-off that we've had. But to your point, that 10-year, it hit 4.215% earlier in this session. Technically, a new 9-month high. And then why did stocks recover off of their low? They were all in the red earlier, and that's, I believe, because the 10-year pulled back below that 4.2% level. That 4.2% level does look a little bit like that is a resistance level looking over the charts there. The closing high that I have from last October is 4.23%, but then we had a couple other attempts around that 4.2%. So I just think it's one of those inflection points. If yields can behave, and I would just say in the near term, stay below 4.2%, maybe that's enough to give bulls some relief, and then we'll see what happens on the retail side of things, not just from the retail's report tomorrow, but we got Target, Cisco, Walmart, you know, all these.
And just like that, it's a bullish day on SPY.
Coming in, so we're going to get a lot of earnings reports to see how the consumer's doing as well.
All right, and if the consumer does show stability,
new high of the day.
What impact do you think that's got at this point, Nate? I mean, it does seem like there's an opportunity here because tech valuations moved so much, a lot of pressure on that group. But we've seen Walmart consistently thread the needle. We've seen Home Depot connected to housing being that rock of the comeback. So if it looks like there's an opportunity, I would think, for bulls to make a case, it would be in some of these companies.
Yes, I mean, on the demand side of the equation, I mean, it's been more on the services than the goods, and we know that's kind of been a bit of a mixed bag. We've seen some weakness in, you know, the luxury goods and that side of the equation.
Great.
I'd say, in terms of the reports, what are you looking for? Well, you don't want too strong of a consumer because that might, you know, hold, you know, some credence
all in the last
to
minute or so.
Higher for longer. Maybe that sends bond yields up a little bit too. So maybe not too hot, not too cold, but if the consumer is still
for all day.
there,
it is
probably what the bulls want to see here
and
this
there's
week.
the bell.
All right.
Thanks, guys.
Well said.
Buys up 0.5%. Oh, 0.54 actually. Barbecue's down 8.5.
Good bit of disappointment
back in its downtrend, it looks like. Uses as resistance, broke through support, made another head and shoulders, did the same false breakout back here. Yeah, nothing good. Sold back out. GME, same deal. Continue to come down. Gap down, big move down, then bounced. No man's land. No, I think it's going to keep coming. Potentially found support on that 19 cents. It won't come lower. That would be consistent with the candle it made today. Is pretty bullish. That's a possibility. Also, that volume today is higher, so maybe the day was the low. I guess I would look for breakout of this resistance at this point. See what happens there. Some consolidation or some new lows. GNS continue to look good. Gapped up this morning. Gapped up to the highs of yesterday or Friday this morning. I bought in more here on the break of VWAP and held above there. So looking good. It's up 31% on the day. I don't think it has much before $2 as far as resistance goes. Yeah, AMC down 35. The AMC ape conversion passed in courts, so dilution. RAD's down 11.25. I was looking at my RAD calls before close. And September's are a little sketchy. It's up January's too. We'll see. I don't like how far it's pulling back. Yeah. I'm guessing engulfing candle would have been a good sign, but really it looked good up until I guess this day was kind of bad, breaking that bull flag. And then yesterday on Friday it looked nice, bounced on 61.8. but now today it's just still not holding that level. Tupperware, end of the day pretty much flat. Not a whole lot. We'll be back tomorrow. We'll see you on Discord. Why did SPY rally so high? I don't know. Set up a bull flag all day. Found support. See this support line it keeps bouncing on? Bounced on there on Friday. And so it's probably gonna at least get to the top of this little trend. You know, before it has resistance. We have data tomorrow morning, 8:30. Not hugely important. Retail sales and import price. Not crazy. Miss came back in after sold Friday. Yeah, I got back in on Friday after hours. Just looking at the chart and seeing how well it held up. For Friday, it looked pretty nice. I got a planner, sold PayPal calls. Nice, Planter's up 2. Still don't like that chart. Make money on your PayPal calls? Short term, huh? Thanks, Guts. Thanks, Lords. Thanks for the support. Thank you, Psych You Up. Thanks, Emperor. Hope you guys had a good day. Red on the day for the SPY day trades. Not much, small losses. 4%. It was less, and then I forced a couple trades, trying to make it back, and market wasn't having it. Chopped me out. I was up somewhat this morning, so need to work on that. And what I do on here? Did I do anything on the options trade? On the long term, I did open up a SPY 445 put for January, so I'll just kind of hedge my long term. And yeah, letting the rest of my long options burn and farming the rest on the Theta farm. Hopefully, hoping those do well. It's mostly long, so that's where nice to have a hedge or two to the downside. Have a good afternoon, guys. We'll see you on Discord. Peace out.